And Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. As the morning grows a little bit older, the equity market rout overnight inches back a little bit. Equity futures now negative just 20, down 0.6%. Tom Keene, what a week still ahead of us.
What a week still ahead of us. Much to do on this Friday, and then, of course, 4 days to the election. We'll talk a lot about that through surveillance here on radio, on TV as well. John Farrell, I've got to go to the pandemic and the fold-in to our foundations of this coming quarter, our foundations to 2021. John, you've got to comment on what Georgieva and the IMF said yesterday, further markdowns for the United Kingdom. Are we going to see those in other nations?
And a call for more fiscal stimulus across the whole continent as well. ECB President Christine Lagarde pretty clear about what she wants to do in December. The ECB already teeing that up. Tom, the colder it gets, the harder it gets in Europe. The cases are going up, more restrictions have come on. That's been the story of this week. Big question for the United States. What's next for the United States the deeper we get into winter?
Well, we've gone back and forth this morning already, John, with differences of opinion towards this election. It's a movable feast. I would say, John, that the one item this morning is the president adjusts his plans for what he will do election night. And he does that because of the pandemic. He had plans to go to his hotel. He will not. The rumor is he'll stay at the White House right now. So things are movable
according to
here.
The New York Times.
Yeah.
The election next week, a Fed decision shortly after, payrolls Friday too. Lisa Abramowitz, we've got to get through the earnings this morning first.
Yeah, and we're going to get some earnings from ExxonMobil. These are the third quarter earnings. The reason why I'm interested in this is for a variety of reasons. First, they announced yesterday that they'd be cutting 15% of their workforce through the end of 2022, including 1,900 people in the United States. Also, though, they may give a read on mobility as we enter into the winter season. I really am curious about that. 8:30 a.m. U.S. September personal income and personal spending data. What it is likely to show is a decline in personal income, perhaps steady on the personal spending. This speaks to the fiscal stimulus that has run out of space here. How much longer can it uphold the economic growth? And then 10 a.m. University of Michigan Sentiment Index. And to your point that you were talking about earlier, Tom and John, about the U.S. and the virus and the spread, we saw a record number of cases overnight in the United States. How much is this going to affect sentiment? How much is this going to affect business activity before any lockdowns, John, go into effect?
That's the unknown. Here's the price action this Friday morning. Good morning to you all. Let me whip through things for you. In Europe, one of the worst weeks we've seen for the European equity market, going all the way back to March. In the United States, S&P 500 futures down 18 points. I can tell you at about 2 a.m. Eastern time, NASDAQ futures absolutely plunged. And then they started to come back a little bit. We've seen a similar story in the FX market. The euro is weaker. Now it's unchanged. Euro dollar 116.74. One consistent through all of this, though, Tom, even with a rout earlier this morning in the equity market, this bond market, the Treasury market specifically, didn't move an inch. 82 basis points on a 10-year.
I don't remember the days now in the blur, John, but I'm going to say 3 days ago we had this. Equities move, bonds don't. Then we had equities move, bonds move, and now we're back to where we were 3 days ago, and you see it with a 0.82% on the U.S. 10-year yield.
James Athey joining us now, Aberdeen Standard Investments Senior Investment Manager. James, let's start there. The lack of Treasury market action on a really whippy 24 hours into this morning.
Yeah, a bit frustrating for us actually as duration bulls, at least. In part, we've been bullish because we thought risky assets were being, incredibly complacent with respect to the outlook across a broad range of factors. We've been thinking about this and trying to piece together some sort of understanding of why that might be the case. I think the story we've settled on really is that this is a position unwind. So what you had was the market was positioning for fiscal stimulus and a blue sweep. Let's be somewhat glib. And that meant being short dollars, being long risky assets, and being in Treasury curve steepness, possibly not necessarily short outright duration, but in Treasury curve steepness. So what we've seen is even though yields have gone up, the curve has actually flattened, and we've seen equities being unwound and the dollar and the yen rallying, which were probably currencies where you had short positions. Certainly the dollar is definitely one where there have been short positions. So we kind of think this looks more like just a clear out of some of those positions, mainly because the virus data's got worse, also because I think some concerns a bit more latterly have arisen that the election result might be closer and might be contested.
Futures right now, -18, as John Farrell mentions, recovering. James Athey, okay, so you have ownership of equities. You have new money to put to work. You have to have a framework, a view out there. Where is there out there? Is it 2021 or is it November 4th?
Yeah, I mean, ideally, we'd like to be long-term investors and we would like to take the long view. I think certainly if you are an equity investor, if you're, my equity colleagues, these guys look at the quality of the firm, the quality of the balance sheet. They're not making an economic call, and they will definitely be able to look through political events like this because they will be comfortable that the company they're buying is a good company at the right price. That's not the case for all types of investment, and that's certainly not the case for all types of investor. So in our asset class, it's a bit more difficult because the prices themselves are very much going to be a function of the result itself and what that means for policy going forward. So depending on the type of investor, you will be able to look through this event to a greater degree. We would find it a bit more difficult to completely ignore, so we will be managing our risk levels and exposures accordingly.
All right, so managing risk levels, and yet you said that it's been a frustrating week for you as a duration bull. What's the hedge here?
Yeah. Well, again, I would have said that, the curve was directional. And so as a duration bull, we've been running, bullish duration positions. And we got some long end steepness on in the US. Well, kind of both of those have gone against us this week. Now, our FX positioning has very much been favorable to the moves this week because we've been positioned long the dollar and long the yen and long the Swiss franc and short some of the risky currencies. And so FX has definitely been a good diversifier and a good hedge for us. But again, going into the event itself, I think the outcome is a lot closer than Nate Silver, for example, is calling it. And so I find it difficult to build a portfolio that I think will be truly robust to every possible outcome. So if that's the situation, I'm going to be happy running some risk in there, some short duration positions in Europe, for example. If yields do go really high, I think European yields will get dragged to some degree. We've seen it's not a huge amount, but they will get dragged a bit higher. So I can go in kind of still having a bit of a small long duration bias, some shorts in Europe, some defensive positions in FX, but just taking the gross level of risk down so that it's we're not seeing huge P&L swings.
James, how well do you think this market has priced in the headwinds to the recovery that we're seeing develop in Europe and elsewhere at the moment? I'm looking back cross-asset. Crude, the dollar bottomed out end of August, start of September. Aussie yen topped out around a similar time. Crude topped out around a similar time. Equities peaked around a similar time. That was 2 months ago, James. I'd argue this market was pretty ahead of some of these risks. What do you say to that?
Yeah, again, broadly speaking, I think we'd gone too far too fast quite some time ago, and it really didn't need the recurrence of a virus spread that we had seen for the market to take some of the air out of that, because again, we were just priced at the extreme of the probability distribution. We were pricing a utopian future where earnings would almost instantly recover, policy was going to be sustainable and effective across the piece, everything was going to be hunky-dory, and the certainty around that is somewhere close to zero. So that was really quite ridiculous market pricing, and we've seen that we've seen some pushback against that. To go to your original question, how well is the market price in the outlook? I would still say, broadly speaking, terribly. Looking at US equities doesn't give you a good picture for global equities. European equities, as you've described, have had a terrible time, a torrid time. Valuations there look incredibly low relative to the US. There are good reasons for that. That still doesn't mean that they're cheap even at these levels. But a lot of assets, certainly in US equity space, really have not taken account of the probability distribution of how this will play out, but also taken account of the damage that has been done and will continue to be done to economies and business models.
James, I just looked, and you can do this, folks, in the Bloomberg, which is magical, in a log chart of the value line geometric index, which is an old warhorse and is some really interesting mathematics and takes out a lot of the emotion, a lot of the dynamics of the movable feast of all these big cap stocks. It is extremely well contained, and it is, as you said earlier, basically a pullback. How do you know when a bull market ends? How do you know as a fundamental guy when a bull market ends?
Yeah, you absolutely don't, Tom, is the answer. You know, in the rearview mirror, I thought, I noted, I can't quite remember who, one of the sell-side analysts was drawing comparisons to this earnings season in the US with the Q1 2000 earnings season, where you got actually solid-looking earnings, lots of beats versus expectations, and yet equity performance on a single name and across the index basis was absolutely diabolical. Nobody in March 2000 or April 2000 was saying that was the top of the NASDAQ and it was over. It was only probably the end of the year when you could look back and go, yeah, we're kind of done here. That's the highs that we've seen, and it takes a long time to get back to those highs when the overvaluation is so extreme. So absolutely impossible to know when it's the top, especially when you live in a world of post hoc justification for extreme valuation, just using rather glib narratives which don't stand up to a lot of scrutiny. And that's been the case for a lot of stock valuations in this period. So I think we will only know in the rearview mirror when it was the top.
Hey, James, great to catch up, as always. Always good to hear from you. James Anthony there of Aberdeen Standard Investments. Thank you, sir. Just want to tune into the equity market just briefly. You've seen NASDAQ futures turning around this morning. They were down about 2% at 2 a.m. Eastern time, now off by 0.9%. Got to talk about big tech at the earnings after the close. Apple still negative in early trading, off by 3.76%. You all know the story well. The weighting of Apple into the NASDAQ 100, it makes up 13% of that index, Tom. When Apple's not doing well, it's fair to say the NASDAQ's not doing well either.
Yeah, well, we're going to see how that works out. And there's been a lot of sell-side reaffirming outperforms and buys. I think Dan Ives darkens our door here in a bit. John, the value line geometric is 1,700 stocks. And here's the key phrase. It's rebalanced daily. It's flat over the last 5 years. That's the partition of the stock market.
On Big Tech, Dan Ives joining us very shortly on this program, Wedbush Securities analyst, coming up from London and New York this morning. Good morning. Alongside Lisa Bravitz and Tom Keene, I'm Jonathan Ferro, with your equity market slowly recovering, with the emphasis on slowly after a brutal week for the equity market longs. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. House Speaker Nancy Pelosi and Treasury Secretary Stephen Mnuchin are playing the blame game. Each blames the other for the lack of a coronavirus relief bill. Mnuchin accused Pelosi of holding up a stimulus bill by refusing to offer compromises. Pelosi says the White House isn't responding on a number of sticking points. Joe Biden has appealed to Hispanic voters in Florida. He told a rally near Fort Lauderdale that, quote, if Florida goes blue, it's over. Polls indicate that Biden and President Trump are virtually tied in the state. Germany's Chancellor Angela Merkel says the European Union should have acted sooner to control the coronavirus pandemic. Merkel told EU leaders that political realities stopped them from imposing restrictions earlier. A flare-up in infections in Europe has forced fresh lockdowns. And British Prime Minister Boris Johnson's government is sticking with its local plan to tackle coronavirus hotspots. Foreign Secretary Dominic Raab says it would be unfair to impose blanket measures when virus rates vary so much across England. Raab says the government is striving to avoid a national lockdown. And shares of Apple are lower today. The company reported iPhone sales that missed Wall Street estimates, plus revenue in China plunged. Apple gave no forecast for the holiday quarter, but CEO Tim Cook says the new iPhone 12 lineup has been well received. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Retail, I think, is strong. We see a lot of people ordering online or going to the grocery store and buying and eating at home. We just don't know what restaurants are going to do this year in the state of Florida, which is the largest consumer of the crab.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Much bigger than any GDP we've ever had. You have to go back to the 1950s, and then it's less than half. This is the greatest, number 33.1%. If you asked me 2 weeks ago, I would have said, I'll take 12%. 12% would have been very nice. Nobody ever heard of 12%. 33.1.
We can build back and build back better with an economy that rewards work, not wealth. And we can do it without raising taxes a single solitary penny on working class or middle class families. I guarantee you, my word is a Biden, no one making less than $400,000 will pay a single penny more in taxes. Not a penny.
President Trump and Vice President Joe Biden both rallying in Tampa, Florida, with just 4 days to go until the U.S. election. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. This Friday morning, the tone of this market just improves a little bit with every passing minute. Here's a shape of the price action. We're down 19. We're off by 0.6%. In Europe, things improve a little bit as well. Euro dollar unchanged at 116.70. Dollar yen the standout overnight. Some yen strength, the 104 handle. And in the bond market, we've talked about this repeatedly. Unmoved, the Treasury market, resilient to everything, it seems. 0.8248%, Tom, on a 10-year yield.
One thing has moved, John, and that is the real yield. And, of course, folks, you can look at a Faro property, the real yield, sometime this afternoon as well, in the later afternoon in London. The real yield from that negative 1.00% bursting through negative 0.90 to negative 0.88. That is a change. It's a little taste of the wind there of what the real yield is doing. Let's get to the politics at hand right now. Kevin Cirilli joins us. Kevin, are they campaigning for the Tuesday voters? After Eagles Cowboys Sunday night, how do they address people that will actually vote on Tuesday versus the mail-in game?
For President Trump, he's going to try to show up. I mean, he's going to be in Scranton, Pennsylvania on Monday night. Of course, that was one of the final stops that he had in his last 2016 cycle. And, of course, it's also hometown to Democratic presidential nominee Joe Biden. It's all about turnout. Biden's going to be heading to Wisconsin today. Hillary Clinton was criticized for not going to Michigan and Wisconsin in the final days up until 2016. And so both of the sides are really just trying to push turnout. From the president's perspective, he got his GDP number, but he didn't get the vaccine, right? Go back to March, go back to April, when there was this push in terms of the economic forecast that we were going to see a strong GDP number, but also that they were bullish that they would have some vaccinations. That didn't, we're still about a month and a half away from that.
Well, let's game play. They're going to run commercials during the defeat of the Eagles by the Cowboys. Sunday night, what message does Joe Biden, what message does Donald Trump want to convey during Eagles-Cowboys?
Well, look, I think it's that audience. To be completely frank with you, I'm not sure that a TV ad is gonna flip anything. But I mean, Texas, battleground state. Pennsylvania, battleground state. Look at the dynamics, as we've alluded to, in both Texas and in Pennsylvania specifically with energy policy. You've got refineries closing down in the southeastern portion of the state. That news just coming out within the last 48 hours, coupled with the racial unrest that we've seen in the city of brotherly love in Philadelphia, where there's a 9 p.m. curfew. So the psychology of the Pennsylvanian voter and whether or not they're motivated to show up to the polls is something that I think is a large unknown variable. Then I've got my eye on Nash County in North Carolina. Nash County, a razor thin a margin for President Trump back in 2016. North Carolina, such a key, crucial battleground state. North Carolina, a state that Obama was able to carry in 2008, but that Republicans have won every other time, including Mitt Romney in 2012. You look at, some of the business fundamentals there. Bank of America, Nucor, headquartered in North Carolina. Get this, Tom. 5 of the 7 paths to victory that the Trump campaign have outlined in the past month publicly include a North Carolina win. So I've got my eye on North Carolina for a lot of reasons.
I will say, Kevin, we're talking about the polls, we're talking about the strategy. I want to know just the practical, on-the-ground effect of the mail-in ballots and what's going to be counted where and when. Which swing states are you looking at to sort of delay the longest to get a result in versus those that will be most prompt?
Lisa, that's such a great point. Yesterday I was reading the Supreme Court ruling that came out from that Pennsylvania case that you and I were speaking about briefly yesterday, and talking to some of my sources, and what they said is that another unknown variable is how precisely the dynamics of this will look because of the volatility. And here's what I mean by that. We don't know which state will matter, so to speak, on November 4th or 5th. So we don't know which patchwork of state regulations in terms of the counting of the vote will matter. If you look at a state like North Carolina, for example, and we're getting into hypotheticals very quickly right now, but we've got to be prepared. If you look at a state like North Carolina, where the local regulations now that were upheld by the Supreme Court earlier this week allow for the votes to be counted 9 days after, that puts us at about 5 p.m. Eastern on November 13th, which is like a 9 day, a week plus out. And in this type of media circus environment, so much can happen in a week in American politics. But that's really what we're dealing with, is that the final vote tallies, if there's a razor-thin margin, might not come in battleground states like Pennsylvania, but in this case, North Carolina, until 9 days after the vote.
Kevin, great to catch up, as always.
Thank you.
Fantastic work. Kevin Cerulli, Bloomberg Chief Washington Correspondent. The numbers, Tom Keene, absolutely amazing. More than 80 million Americans already voting. What's that, 60%? Of 2016's total?
Yeah, we're in the vicinity of 60%.
4 days to go.
In some of the states, John, are way more than that. What I would emphasize in that point, John, forget what I think or you think. The pros in this game, that's the first thing they mention every conversation. There's no other topic than the early turnout.
The one that really stands out for me, Lisa, is Texas. Almost 95% of the 2016 vote, just the total.
Yeah.
Almost done, early. It's incredible.
It is incredible, and we'll see if we're going to see overall massive turnout or whether everyone's just mailing it in because they don't want to get sick going to the polls. One of the things I find most interesting about this election, I read a lot about what Joe Biden's plans might be, what his platform might be. It doesn't seem like anyone's gaming out a second term of President Trump, and you do have to wonder how much of a surprise it could come if, say, he is up in the polls, if he is up in the election results in the immediate aftermath. That could be a massive disruption to markets, John.
Tom Keene's given it plenty of thought because Tom Keene does not believe in these polls, as he's told us repeatedly over the last several months, Tom. repeatedly.
They've come in.
I say a poll. Tom says no.
He says triple over cash.
I talked to the pros, and they're coming in just like they expected, except the national poll.
I will tell you this, though, Tom. If you take a look, there was a story in the Wall Street Journal about how even the people who were for Trump in 2016, the big investors, are not saying that they think he's going to win. So even if people say we don't believe the polls, they're still pricing in that Joe Biden will win. And so, honestly, that's sort of the conundrum in markets right now.
It's a big conundrum in this market. After that election, you also have a Fed decision and payrolls Friday. Next week could get messy pretty quickly. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From London and New York, this is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 2 hours away from the opening bell this Friday. Just a few more trading days to go. until an election in America. Here's the price action. Futures recover just a little bit, then they roll over. The Dow 21 with negative 0.6%, a recovery in the European equity market, seeing some positive gains across Europe after 4 days of brutal losses. Euro-dollar unchanged at 116.73 in the bond market. A 10-year Treasury unfazed by everything, it seems, 0.8265%. In the United States, not just about the S&P, the NASDAQ futures were down 200, off by about 2%, now down by about half of that. Apple shares falling after the company reported iPhone sales that missed estimates. The CEO, Tim Cook, cautioning that the latest iPhone 12 has been well received, but the company is facing some strains due to the coronavirus.
If you look at iPhone, we are constrained today. How long we will be supply constrained, it's hard to predict. We're supply constrained on Mac, we're supply constrained on iPad, and we're supply constrained on some Apple Watches as well. We're working really, really hard to remedy those as quickly as we can. But at this point, I can't estimate when we'll be out of that.
And that was the problem, not just for Apple, but for many other companies that reported after the close. Tom, it was about the outlook and the lack of visibility that so many of these companies have.
I just call it all-American uncertainty here around very good financials as well. Daniel Ives is an uber bull on all this. He has been across all of media talking up out 1 year, out 2 years, out 5 years. Daniel Ives, can you write today for Wedbush with a 2- and 5-year model, or is the uncertainty so great you've got to pull in your timeline?
Yeah, it's a great question. I mean, I continue to sort of view it as near-term uncertainty, but let's say in the case of Apple, 40% of the install base hasn't upgraded their phone in 3.5 years. So I think the pent-up demand, when I look out, I even think over the next 12, 18, 24 months, there's a little more visibility when you look at Apple from an install base perspective. But no doubt, I mean, that you guys see forest through the trees here on tech. We continue to be bullish.
You know, I look, Dan, at the people looking at 90 days out or even a year out, and if you take any of these juggernauts and model them 2 years or particularly 5 years, it's shocking the growth. Is that growthiness still there, represented by revenue growth, but can it come down the income statement and persist out 5 years?
Yeah, I think it's a golden age for technology, which speaks to our bullishness over the last few years. I think we're only in the middle innings. You look at some of these names, the profitability profile is dramatically higher. Look at Apple in terms of services. I mean, that gross margin's about double the hardware business. And I think what you're seeing is it's very easy, especially in the jittery tape, to get myopic and nervous on some of these prints and guides. But for Apple, the super cycle hasn't even started. And in terms of our Asia checks, we think pre-order activity is more than 2x iPhone 11. So I think that's why when I look at Apple, on sort of knee-jerk reaction, you look out over the next year or two, and I think this is ultimately a $150 stock 6 to 9 months from now.
So, Dan, why do you think the stock's down about 14% from the September high?
I think part of it is just general nervousness going into the super cycle. China, obviously, is a key. That's the hearts and lungs of the overall cycle. And if you look, you know, and you saw this quarter, I think there's just general nervousness that you're not going to see that demand. Valuations had a huge re-rating, and you start to see perfection built in. And I think you're seeing a risk off overall in tech just going into the next week. But I believe it's short-lived. That's why I still think it's green light to own tech. And I think I look out over the next year, and I think tech stocks are up another 20% plus.
That's been your call through much of this year. It feels like a rolling 20% call, Dan, and for much of this year it's been dead on. But something happened in early September. Dan, some people are asking whether we've already seen the pull forward for Apple through the shutdown. And this is not about waiting for the iPhone 12. This is the payback for a really decent quarter when the world was shut down. What's your response to that, Dan?
Yeah, you've seen the pull forward on Macs and obviously on iPads. You've not seen the pull forward on iPhones. And I think that's really the key here. You're going into what I view as a once-in-a-decade super cycle for Apple. So that is still on the horizon, especially when it comes to China, because you got 40% of the install base that hasn't upgraded their phone, and a stock that gets re-rated on services, which next year, that's going to be north of $60 billion. And that continues to be the crux of the thesis here in terms of that's playing out. And this quarter doesn't change that whatsoever for me.
Dan, one aspect of the big tech earnings that strikes me as odd is that they continue to trade as a monolith. In large part, people talk about big tech in tandem as though their fates are intertwined, and yet their actual business models are vastly different, whether it's an ad-driven model, whether it's a Google search model, whatever it may be. And then you have Amazon, which knocked it out of the park in terms of projections, and people still are punishing them. Do you expect divergence in the fates of these shares, and who will be the loser in the next year?
Yeah, I think maybe you saw a little of that divergence with Google, especially over the last 3 to 6 months. And obviously they knocked it out of the park last night from an advertising perspective. I do think a lot of that could be on the antitrust. As you start seeing more and more pressure from antitrust going into next year, specifically, if you see a blue wave, the Googles and the Facebooks, could potentially trade a little different than the Apples and the Amazons on the platform play in terms of those secular trends. But for now, we do view them as a group in terms of FANGs. I'd also put Microsoft in there. The platform plays and the strong are getting stronger. And I think you're seeing that in this environment. COVID's accelerated the growth rates on the consumer and the enterprise by 1 to 2 years. And I think that's playing out here, even though you'll see some of the knee-jerk reactions on, we'll call it sandbag guidance from the likes of Amazon.
Well, Dan, they're increasingly being treated as the haven investments because of what you talk about, the strong are getting stronger, and yet the valuations, the multiples are getting higher and higher, and people are saying, well, it makes sense with such low yields. How much would you change your call if benchmark rates in the U.S. went up?
Yeah, I think that could change things, but I also think what's starting to happen is investors are viewing them sum of the parts. You look at Amazon, AWS, e-commerce. You look at an Apple from a services and from a hardware perspective. So I do think what's started to happen is, in terms of some of the breakup talk, the sum of the parts, the re-ratings that you've seen, I think that's the key. And also they're safety blanket names in a Category 5 storm. But then on the other side, you start to see more of a risk-on trade. Tech continues to lead the market higher. And I don't see that changing here in terms of just the shifts that we're seeing. Yeah. And I think it's evident through earnings season.
Dan, one of the great questions here, and I just did a quick Faro interpolation of the share buyback program of Apple. And folks, basically out 10 years, they go back to where they were in 1992 in terms of number of shares outstanding. Dan Ives, other companies have tried that, Intel, IBM, and that story didn't work out so good. Is Apple correct to be so aggressive of buying back shares?
It's hard to argue with the strategy in terms of what you've seen on the net neutral cash policy. They're not acquisitive. And the buyback combined with, and again, the reason I think it hasn't worked for some of those companies, they didn't have a golden install base and anything close to what the iPhone is, with a 96, 97% renewal rate. And I think just given they have more cash in some countries, they're not going to acquire. Well, that's from an investor perspective, I think the right thing to do.
I happen to agree with you, but what I find stunning is the margins of the growing service sector. Do they sustain those 40, 50, even 60% margins in service?
Well, I do, and that's why I think the services business, let's just take, and we said some of the parts, I think that services business is worth $900 to $950 billion. And that's been a key part of the re-rating in the stock over the last 6 to 9 months, as it's held up like Rock of Gibraltar, if you've looked at the services business. And I think those margins, Teflon-like, can continue to, I think, stay where they are or potentially go higher. And that's a key part of the bull thesis.
What do you make, Dan, of the fact that China sales of the iPhone and just in general dropped 29% of revenue for Apple? The idea that perhaps this has to do with the new phone coming out, but even more so perhaps the tensions that are growing between China and the U.S. when it comes to tech.
Yeah, and I think tensions that's been there, poster child for U.S.-China trade war, just overall cold tech war. But I think this quarter is a throwaway quarter for China, because it all comes down to, you see a pause ahead of iPhone 12. I mean, we believe you could see growth in China, double digits starting in the December quarter. That's why I wouldn't read into this. In other words, it's a scary headline. Stock will be down knee jerk. I think 3 months from now, we sit here, we're talking about, how is China that strong in terms of iPhone 12? That's based on what we see in terms of checks and pent-up demand.
and we'll see you in 3 months. The bull is still a bull. Dan Ives of Wedbush on the safety blanket in a Cat 5 storm. Apple right now, negative 4% in pre-market trading. Tom, we talked about this a couple of times through the week. I've brought this up many times through the week, in fact. There's information in the news flow, and then there's information in how markets respond to the news flow. And these markets, Sarah Ponzek writing about this extensively over the last couple of weeks. These names, Tom, if you haven't beaten big, if you haven't provided some nice fluffy guidance, fuzzy, nice and warm, just to make you happy about the future, these stocks get punished, and these stocks got punished after the close and into this morning.
They got punished after the close. It's been interesting to read the articles today. James Suva, who was with us yesterday with Citigroup, same idea. And they're just, you know, as Jim Suva said, they're modestly tweaking margins, et cetera, out. But I didn't see a lot of change on the Excel spreadsheets forward from the analysts.
What was your take, Lisa, after the close yesterday, with those blowout numbers from some of these names, and then it was about the lookout, and not much of one?
Yeah, well, but there was much of one when you talk about Amazon. I mean, they actually came in, their forecast was above expectations, and a lot of people thought that it was overly conservative, that they're going to do really well in the holiday season, and yet their shares are down pre-market. To me, it feels like people are so concerned that things are overbought, and they want to pair risk, and they sell what they can, John, and these have become the beta stocks. These have become the easy, safe havens where you can sell and you can buy easily, depending on your risk appetite.
They are the market, so to speak, at the moment, given up how much they make up of this market right now. Here's what the market looks like at the moment. We recover a little bit in Europe to just about flat. In the United States, on S&P 500 futures, we were deeply negative. NASDAQ futures, much more so overnight. Then we come back. We pair those losses, and then we roll over. We're down 23. We're negative 0.7%. It's another choppy morning for the equity market, and a morning where the bond market just does not want to participate. Yields, 82 basis points on a 10-year. Your euro on phase, euro dollar 116.69. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. They weren't able to agree on a coronavirus relief package before the election. Now Nancy Pelosi and Steven Mnuchin are still battling over terms for a post-election deal. The Treasury Secretary accuses the House Speaker of refusing to compromise. Pelosi says she's waiting for Mnuchin's response to her demands. The path of the U.S. economy is less certain after record quarterly growth. Third-quarter GDP soared 33.1%. That largely reflected a rebound in economic activity after widespread lockdowns earlier this year. Economists are projecting the U.S. economy will grow anywhere from below 3% to about 6% in the fourth quarter. The U.S. has set a record for its most coronavirus cases in one day. 89,000 cases were recorded. There's a jump in infections again in New York and New Jersey. Plus, there's a record outbreak across the Midwestern states. You can assume that ECB President Christine Lagarde has signaled that more monetary stimulus is coming. That's according to one of the bank's policymakers, Robert Holtzman. He spoke with Bloomberg.
This is a correct interpretation with some caveats. The one is, she also said it's very clear that we use the December projections and the information in December to make our decisions. What we've decided is to make preparations, to go through our whole portfolio and see in what area we need to recalibrate to be ready for December, but the decision will be based on December data.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
What is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The resurgence in coronavirus infections presents renewed challenges to public health and the growth prospect of the euro area and global economies. Incoming information signals that the euro area economic recovery is losing momentum more rapidly than expected.
ECB President Christine Lagarde really leaning into a recovery that is fading fast across the Eurozone and teeing up the potential, the prospect, the likelihood that we get more stimulus in December, indicating everyone on the Governing Council had agreed to recalibrate the instruments at hand, Tom. And I think that's the story overnight into this morning. More stimulus coming from the ECB.
Well, maybe from the ECB, but everybody else as well. And you really wonder with the pandemic news, John, are we really beginning to see, you know, here and into the week and after the election, a tectonic shift in size of stimulus? I don't see anybody talking about that, John, because it's pretty much, do you agree, unimaginable that would sum out to many trillions of dollars?
What I thought was amazing yesterday, at one point, I thought that President Lagarde was putting a rate cut on the table at the ECB, and many people thought it was the end of rate cuts. We caught up with the Austrian Central Bank Governor early this morning here in Europe. Maria Tadeo headed out to Vienna to catch up with him, and he ruled that out. He essentially ruled out the prospect of a rate cut. So for those of you worried about the prospect of even deeper negative interest rates across in Europe, the Austrian Central Bank Governor, Tom, ruling that out. But I think more QE, very much on the table, more bond buying to come in Europe.
We haven't mentioned it this morning, but looking at negative interest rates in Germany and Switzerland, there's stasis there, not worse negative interest rates, but I would call it stasis after a challenging week. On the vaccine, on our biomedicine, as we search for a vaccine, we talk to physicians, we talk to those of traditional pharmaceutical. Evan Siegerman is with Credit Suisse with just a huge success at one of the toughest accounting courses in the country, the University of Michigan, and he joins us this morning to look at the debits, the credits, the hopes, and the dreams of our biotechnology. Evan, your reports are unreadable. They're in Greek. They have way too many multi-syllable words about the biotechnology of this moment. Translate for us the major research goal of big biotech right now.
Well, thank you for that introduction and good morning. So, of course, in biotech, there's a lot going on. I think the major research goal at the moment is dealing with the pandemic. Before we went on air, we were talking about when is this going to be over? Right now, we need vaccines. That's hopefully coming with, we're hopefully going to have positive data by the end of the year. I know people are very anxious for that. But in the meantime, we've also had developments from Gilead, like with remdesivir. I know we can debate the efficacy, but the fact is it is FDA approved, and patients who are in the hospital seem to do better if they're given remdesivir. And we also have antibody cocktails from the likes of Regeneron and Eli Lilly. The Regeneron cocktail was actually what President Trump was given a couple of weeks ago, and he
okay,
was
well,
very
what did that?
enthusiastic
Come on,
about that.
come on. What?
Yep.
My record price
What?
for a martini is $41. What did that Regeneron cocktail cost Walter Reed?
That cocktail cost them nothing because it was part of a clinical trial.
Oh, but come on, give me a price. Give me a price of what something like that is going to cost.
Well, something like that. So that's a very good question. I know you're pushing on that. One key data point that we have is BARDA has a contract with Regeneron for about 300,000 doses at about $450 million. So do the math, $1,500 or so per dose. But one of the things when I speak with the company is they caution on using that as the go-forward price. But that's the best thing we have. I think that's somewhat reasonable, a little less than a course of therapy for remdesivir. And this would be for the treatment setting, of course.
Well, and I think what Tom's getting at here is, given the public health nature of all of these remedies and the vaccine, and the fact that the government is footing the bill for a lot of it, and a lot of the pharmaceutical companies are footing the bill for the R&D here, how do you, as an analyst, game out the profitability of their involvement in this?
That is my that is my challenge every day. These models are constantly changing, so I'm going to caveat it with that. When I think about it, I look at it, how important it is to just get out of this kind of current phase of the pandemic. We want to go back to normal. We need therapeutics that are effective, and more importantly, we need vaccines that can be given to the masses. When I think about therapeutics like remdesivir, we know the price, we know it's relatively profitable for Gilead, but they did invest, $1 billion plus this year in getting it up and running. And that's pretty impressive considering this pandemic really only started in January. It was on our radars in January and started in March in the United States. With the therapeutic antibodies, I think what's going to happen near term is it's going to be a direct sale from Regeneron and Lilly to the government for distribution. So you're not going to be able to necessarily get it. You're not going to have it distributed through a normal pharmaceutical method. And the reason I bring that up is because that's how the pricing is. I think that these companies are going to make some profit. They're not going to be unreasonable. This is something I've talked about before. But again, we're still kind of early in the phase of figuring out what the ultimate impact of profitability is in 2021 and beyond. And it may not even be so because we could have a vaccine next year where these become less relevant.
And meanwhile, as we speak, Evan, AbbVie just posted a full year adjusted EPS forecast that was above expectations and raised their dividends. So they seem to be doing okay.
Right.
There have been a number of expedited vaccine approval processes, particularly in the UK. How soon, based on the latest research, do you think we will get an approved vaccine?
Well, an approved vaccine, probably under emergency use authorization versus full FDA licensure. I'm cautiously optimistic that we could have data from the Pfizer vaccine some point late November potentially. And I expect once we have the safety data in hand that they'll go right to FDA based on some of the commentary that the company was talking about earlier this week on their earnings call. So short answer, hopefully by the end of the year or at kind of the latest, some point in first quarter next year.
Evan, thank you. Appreciate your time this morning, sir. Evan Siegerman there of Credit Suisse on the potential of a vaccine. Thank you, sir. That's the difference between now and March, going into the lockdowns we see in Europe, the increase of infections in the United States as well. The horizon feels different, Tom, for many people. On the horizon, people hope a vaccine just around the corner. On the horizon, people hope much more fiscal stimulus still to come. In March, you were just staring down the barrel of the complete unknown. No idea how long this would go on for, no idea how to treat it.
I looked at the vectors this morning, and the cases and the death vectors are not attractive. John, you're again way out in front of this. I've mentioned that a couple times this week. The heart of the matter there within biotech and big pharma is going to be the cost, the efficacy of delivering this to millions and millions of people. John, I don't know how you do it at $1,500 a dose.
The social stigma attached to making a profit on it as well, Tom. That's going to be a big issue that we've discussed with pharma CEOs many times throughout the year. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Counting it down to an opening bell stateside with the market shaping up as follows. Let's whip through the price action for you on the S&P 500, on the NASDAQ. We do erase some of the overnight gains, losses rather, down 25 on the S&P 500 now, off by 0.75%. We were inching back, and then we rolled over. Euro dollar 116.71. I've got to say, foreign exchange getting more interesting this week. Coming up, Jordan Rochester, G10 FX strategist for Nomura. Looking forward to that conversation. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. What a week we've got coming up next week with full coverage right here on Bloomberg Surveillance. This is Bloomberg.
History of having to support each other, right? And so there are opportunities that are presented that we don't often qualify for. So oftentimes we have to turn to our neighbor and turn to people within our community to assist us, to help us.
The Oakland African American Resiliency Relief Program was created to support and fund Black-owned businesses in the city of Oakland. The reason we started this fund due to the systemic racism behind the PPP funds, also how our Black-owned businesses have been marginalized for so long.
I'm standing here right now because we did get the resiliency fund. I only had enough to kind of just pay payroll for a couple of more months, but I said no new initiatives. Now that we have some new initiatives, we have other revenue streams coming in, and that's what's helping to keep things up.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
we're heading towards a double dip.
We could be in for, a prolonged correction.
What we need is central bank keeping stability in financial markets.
Policy in the United States on the fiscal side continues to come up short.
The longer we wait, the bigger that package will need to be.
It's clear that we are going to see downward revisions in many businesses.
We don't have safe havens anymore.
I find it difficult to build a portfolio that I think will be truly robust to every possible outcome.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday, an exciting Friday before the first Tuesday of November from London, from New York, on radio and television worldwide. We are thrilled you are with us. There is market turmoil. Futures terrible earlier, now doing better. Negative 25 on SPX futures. We're going to talk really interesting dynamics of the great depth of the market, which is foreign exchange. We'll do that in a minute. But, John, we've got to look at a president who launched 10 tweets last night, somewhere in the vicinity of 2 a.m. I don't know what it was. The president says, quote, watch the great red wave, and that goes to his hope on Tuesday.
And wasn't that the perfect GDP print to take on the campaign trail? What did we say, Tom? Use the number. Don't mention it's annualized and talk about how big it is. That's exactly what the president did. The question people are asking, Tom, is whether the final days are just too late to make a difference, given how many people have already voted in this election and how wide the national polls have been. Now, we've done this movie many, many times before between us. Everyone's seen it. I say the polls, you say mayor. The difference this time around is much, much wider than what we saw in 2016. I've repeated this before. I'll repeat it again. In 2016, Clinton had a lead of 3 points on the day of the election. At the end of the election, it was a 2-point lead in Clinton's favor at the national level. You know, we all know, this will come down to a handful of states. Tom Keene, in some places, for instance, Florida, that has tightened up a little bit on the average polls in the last couple of weeks, and that will be the focus the morning of November 4th.
And certainly on Tuesday, well, you get to November 4th, Wednesday, we'll have some special coverage for you then, of course, but I wonder how far out in November we go to learn of the president and the Senate's future as well. Lisa, I look at yesterday as well, and, McKee's forced us to look at economics here with all these distractions, but the labor economy yesterday barely got summarized, did it? Give us a summary of what you observed yesterday of the American labor economy.
Well, the numbers were better than people had expected, but they're still brutal when you look at any kind of historical precedent. I think, we're talking about the election 4 days away, and I guess a week ago, we probably would have said this would have been the dominant theme today. But really, when we talk about the labor market and everything else, and particularly in markets, it's all about the virus. I just want to bring you this, Tom. A headline just crossing that 1 in 100 people in England are infected with COVID-19. This being reported by ONS. It gives you a sense of the shift in tone and how really this is going to be the main driver heading into December, more than even the election right now.
Well, the pandemic across the battleground states, and of course both candidates visiting there, very heavy growth of cases and even beginning to see a growth of deaths. John, you were weeks out front of this. Into this weekend, John, what are you trying to study, to think about of the pandemic across greater Europe?
I think the greatest unknown is actually outside of Europe at this point, Tom. In Europe, the data and the loss of momentum was pretty well flagged. It started in September in the PMIs and bled across into October as well. For me, the unknown is the United States. The cases have been picking up. We don't have the restrictions in the US like we do in Europe. But what we saw in Germany before the restrictions even came through was consumers starting to disengage because of the caseload. That's what you've got to keep your eye on for in the United States and the U.S. economy. How sustainable is the recovery? How durable is it? And will consumers disengage if these cases keep heading the wrong way?
And deaths picking up a little bit. Nothing like the cases in the United States, but nevertheless, there's a lift. We've got so much to talk about here across the morning on Bloomberg. Thank you for joining us. Jonathan Farrow with Mohamed El-Erian coming up in the next hour. Jonathan Farrow with the real yield. Look for that later today. The real yield, I should point out, negative 0.8809. And, of course, look for the close in London as well with Mr. Farrow. You'll see that sometime in the vicinity of 5 p.m. London time. Right now, we are in the vicinity of Jordan Rochester, Nomura G10 FX strategist. And I want to go to a brilliant single sentence, Jordan, in your essay this morning, which is you got stopped out of a trade. I want you to explain the value to global Wall Street of being in a trade like you were. You got it wrong and you got stopped out. Explain that process.
Well, Tom, morning, guys. Hi, John. Hi, Lisa. It's about transparency, Tom. What I try to do is I have my frameworks, my way of approaching trades, and certain levels where we talk about the trigger points. So what you're referring to is I had short Eurodollar on just the other week on the back of I think John was alluding to this as well. We saw the cases picking up. We saw the hospitalizations picking up in Europe. Germany's included too. And the idea of mobility data deteriorating, consumers starting to step away a bit in Europe, we had seen that as well. And so we had Eurodollar trading around 118.50, which was actually the level we said, if we go above that level, we might be starting to approach 120 on the idea of that's what a blue wave scenario in the US election could do. But part of the problem with trades is you can have the right foresight in predicting virus cases going up, lockdowns to come, but it's about knowing the right moment, Tom, when the market will price that in. And so in my case, in that example, got the right view, had the right direction on where lockdowns were going to go, just bad timing. And I think right now there's a difference for markets that we need to talk about when it comes to these lockdowns.
That's, John, like my bets on the tots. You know, I can sometimes get my bets on the tots right, but I just get the timing. Antwerp, John, they lost. What's Antwerp? Well. They lost to Royal Antwerp. Help me.
Jose Mourinho wasn't happy about that result. We can talk about that in a moment, Tom. I want to continue the conversation on foreign exchange if I can. Euro-dollar 116.70, Jordan. We're sitting right on top of the 100-day moving average on the euro. You were talking about that short down from 118.50. Have you taken that short off, Jordan?
So yeah, right now we're currently completely flat in the euro. We've actually got some long exposure in the pound because of the progress we think we'll see hopefully next week. There's a sort of deadline of progress perhaps next week on those talks with Brexit. So we've got a long cable position. And I think this kind of all goes into the US election as well. Next week's such a jam-packed week. We have what's going on with, as I mentioned, Brexit talks. Then you've got the US election. You've got the Fed. There's various reasons to be expecting movement in currencies next week. And I think a lot of it's going to happen all at the same time. Yesterday, we saw the ECB deliver a more dovish than expected communique. The word will. They will look to recalibrate all of their tools. So not just QE, even looking to recalibrate perhaps the front end. We expect a rate cut in December, for example. But the point I've made to clients is, yeah, we expect the ECB to do everything, throw the kitchen sink at the problem. But next week, we've also got the Fed, and given the situation in cases in the US as well, and the situation for global risk sentiment, the Fed will also be looking to do something similar. Not a rate cut, but at least providing support and expanding their balance sheet once again. So I think the risk reward is here from this level, John. In Eurodollar, we're at the bottom of the recent range. Folks have kind of de-risked into the US election because of the situation going on in Europe. I think the opportunity is there for buying some Euro topside.
I got to say, Jordan, next week is going to be wild for foreign exchange traders. Not only do you have the Fed meeting, you also have the election, and people are very clearly positioned for Joe Biden to win the presidency. We may not get a conclusion. What kind of volatility do you expect? Do you expect the dollar to strengthen significantly if it looks like we're heading toward a contested election? This irony that the haven investment is also at the heart of the political turmoil.
Yeah, absolutely. And the reason for that is because of the positioning. So we look at the futures data. We've seen investors kind of cool off in the past couple of weeks, but they haven't reduced their short dollar positionings enough to say it's balanced. It's still very short the dollar and quite long the euro as well as a result. So if you have uncertainty, it leads to risk sentiment falling and positions just get reduced as a knee-jerk reaction. So if you saw Joe Biden lose the election next week, or if you see the Senate lead to a Republican outcome, or like you say, if we just don't know the result for a couple of days, that could definitely push Eurodollar lower. That could see us go to 116, down to 115. And in the scenario where you have a split Congress, 114 is not ridiculous to talk about. But what I would like to talk about is the experience that we all had together when I was sat with you in the studio in 2019. John, you may remember this, Tom, when we had the UK election and we had the exit poll come out showing a strong showing for Boris Johnson. And during that campaign period, the polling for all of it said Boris Johnson was going to win. But because we were so paralyzed by the 2017 experience of the polls getting it wrong, investors actually didn't fully price it in. They didn't have the positions on that they would want. And I think with this US election, we have a similar situation where we're so haunted, I know it's Halloween, we're haunted by what happened in 2016 when it came to the surprise Trump win. That even though, as John was pointing out at the top of the hour, when we have such clear polling leads for Joe Biden, we are not fully pricing it in. So if we get the outcome that the polls suggest, the dollar will still sell off.
Well, let's get a trade, Jordan. Before you go, let's get an election-related trade. Something exotic, long peso, ruble. I don't know what it is, Jordan. What's on your mind?
John.
Well, I think it's still very much a favorite amongst markets is to be long CNH. So shorting dollar CNH is still a market-favored trade. In terms of the sort of exotic stuff, well, what you're going to have is you're going to have a big jump higher if you have the blue wave scenario. So looking for something like breaking the ranges out of euros, so buying 120 topside or something like that. Short dated is the sort of stuff I'd be looking at, definitely in this scenario, because as you guys mentioned, a lot's happening next week, and so that's when the action will be. So just short dated stuff is where I would be focused.
You're so G10 and vanilla, Jordan. It's great to catch up with you, though.
Yeah, that was very exotic.
Rochester of Nomura. I appreciate it.
That was exotic.
That's Paul McNamara of GAM was talking about this one on Twitter, and I actually think it's something worth thinking about, Tom. Peso on the one side, ruble on the other. If Biden wins, the idea being that's good for the peso, bad for the ruble. They're the kind of things to think about in foreign exchange if you want to get a little bit creative.
I'm changing my tune. I'm looking for an exotic entry point. I want an
Into the
exotic
FX
entry
market.
point.
This is going straight
What in
downhill.
God's name does exotic mean?
Just anything outside of G10. I don't know, Tom. Just get creative.
Exotic.
We've got to talk about sterling and the euro all the time. It gets boring. Don't you think it gets boring? I think it gets boring.
Would I think that?
Ed Mills up next. He's not boring. Raymond James, Washington policy analyst. Jordan Rochester, for the record, is not boring either. Just want to throw that out there.
He's
Futures down
exotic.
29. We're down 0.9%. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. House Speaker Nancy Pelosi and Treasury Secretary Stephen Mnuchin are playing the blame game. Each blames the other for the lack of a coronavirus relief bill. Mnuchin accused Pelosi of holding up a stimulus bill by refusing to offer compromises. Pelosi says the White House isn't responding on a number of sticking points. And Joe Biden has appealed to Hispanic voters in Florida. He told a rally near Fort Lauderdale that, quote, if Florida goes blue, it's over. Polls indicate that Biden and President Trump are virtually tied in the state. Shares of Apple are lower today. The company reported iPhone sales that missed Wall Street estimates, plus revenue in China plunged. Apple gave no forecast for the holiday quarter, but CEO Tim Cook says the new iPhone 12 line has been well received. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific, only on Bloomberg Television.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
More than 225,000 people dead. 225,000. The estimates are, if we acted responsibly, there'll be 160,000 fewer dead than there are today. Because of COVID-19, we're now past the 9 million mark of people infected.
They're spiking up big. They're shutting down. They're locking down. I disagree with that because we're never going to lock down again. We locked down. We understood the disease. And now we're open for business, and that's what it is.
President Trump and Vice President Joe Biden both rallying in Tampa, Florida, with just 4 days to go until the U.S. election. As we wrap up October, 2 months to go through 2020. This year's a blur. Here's the price action this Friday morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, live on Bloomberg TV and radio. Equity futures down 36, negative 1%. We were recovering a couple of hours ago, and then we rolled over again. In the bond market, you cannot get a bid. 10-year Treasury, 0.81%. But the route's there to be seen, Tom. It's in the equity market. It's in the NASDAQ. It's off the back of those tech earnings. And in the FX market, you do still have a bit of dollar weakness in the mix through much of G10.
It's decidedly discrete to equities, folks. Even in the bond market, flatness, equity market flatness, commodities, oil down 17 cents. So I'm going to call it some tech angst and maybe some Friday angst, and we'll see what the news flow is today. Right now, we continue on the politics as we heard the gentleman from Tampa, Edward Mills out of Boston College, a storied career in Washington, working in the legislative branch, particularly for Congresswoman Mahoney of New York. Ed Mills joins us from Raymond James right now. Ed, you've got too many numbers in your latest research report, but the answer is you see the possibility of a Biden victory, a possibility of a Democrat Senate. Do you have any sense, with your years of expertise, of the when of it? When will we know that?
Yeah, Tom, it's a great question. Our latest report is titled All Blue or Deja Vu. And, you know, we certainly do think that this is a lead for Democrats. We asked the question, can Trump win? Absolutely. Can Republicans maintain the majority? Absolutely. But we just give that lower odds. In terms of the timing here, we do think that we're watching North Carolina to see if it can give us an early signal. They count their votes in advance. All the absentee votes started counting 14 days before the election. If we can get a clear winner in North Carolina for the presidential race and or the Senate race, and it has broken to Joe Biden, we think that's an early sign that there has been a Democratic sweep. If it's close, if it's inconclusive, we may have to wait for a while, and we are warning clients about the potential for a blue mirage or a red mirage, where the initial count versus the final count is significantly different.
I want you to talk, and this is where Ed Mills is so good, folks, is on, you know, the machinations of the House and particularly the Senate. Ed Mills, Politico did the article about who would run the committees if the Democrats take over the Senate House. How progressive would the committee leaders be with a Biden presidency, or would they be, as President Biden is perceived, to be middle of the road? Which is it?
I think it is both. You certainly could see a budget chairman, Bernie Sanders, or are we going to see him kind of stick around in the Senate, or is he going to make a play for Labor Secretary should Biden win? In the Banking Committee, Sherrod Brown, it's interesting to me, Sherrod Brown was as the progressive voice of the House and Senate before us as more pragmatic, especially when you compare him to other colleagues. So, you would see a pretty progressive chairman of the Senate Banking Committee as well. Ultimately, it comes down to what you have the votes for. And when you look at who's most likely to win Senate seats and what the Senate majority would look like for Democrats, you have to realize that there are a number of pretty moderate to conservative Democrats who are running, and if they win, that's the majority. That's the difference maker. So on big bills like taxes, they probably stick together. More ideological things, it would be difficult to get those done, and so you'd be more towards the center versus a push towards the left.
Ed, how significant is the dynamic of Republicans registering more voters, particularly in swing states, as they've been claiming?
It's the debate of the election. We've seen registration gains in Florida. We've seen registration gains in Pennsylvania. Ultimately, if Trump wins re-election, this will be the focus of where the Biden campaign didn't go strong enough. You saw Republicans continuing to register throughout this year where Democrats went on the sidelines because of COVID concerns. There is a real debate within kind of the political community on whether or not kind of voter turnout among groups that didn't show up in 2016 that have favored Democrats will overcome that. How much of that registration was a switch of people who voted for Trump in 2016 that were registered Democrats who switched their registration to Republicans? It certainly is a bright spot for President Trump. If it's enough or not, we have to wait and see.
Just quickly, just to think about what a second term would be like, what's the policy priority, the number one priority of a Trump second term?
I think it would be all about the economy. I think we would see another push for tax changes. We'd be ensconcing a lot of the regulatory changes, and it would be a doubling down on the China trade fight.
Ed Mills, Raymond James, Washington policy analyst. Tom, something to think about, whether either side, whoever wins, we're going to see that stimulus. There seems to be that kind of theme. We caught up with Lee Farage of State Street earlier this week, who said, look, whatever happens, whoever wins, stocks are going up, we're getting more stimulus, we're good to go. Some people share that view. I'm not advocating for it. I'm just highlighting that it exists. It's out there.
Well, what's interesting, John, about this, and it's great to have Edward Mills on from Raymond James, like Henrietta Trey's, there's no substitute away from the pundits of people that have actually worked. I mean, let's be honest. When Cirilli shows up on Capitol Hill, he's not working.
Hey, Kev.
But the people there, the people there that are working, I mean, they've got a huge perspective on actually how does it get done? How does stimulus get done? And I agree, it's up in the air.
I think you just said that Kevin Cirilli doesn't work.
Wait, excuse me. Hold on a second. I think Kevin's calling.
What you said.
No, you're fine. You're good.
What did he say?
No, I know. We know you're working. Yeah, no, he's just saying that he works all the time.
Seriously, Tom, it's a pretty rude thing to say.
No,
and Kev,
but I mean,
hey, Kev,
on
that's
Capitol
working.
Hill, there's only certain people that are really part of the process. Ed Mills is part of that. Henrietta Trey's is part of that. They've got a huge knowledge about, how does a sausage get made?
I hear you, loud and clear. Very passionate about this.
I am. I mean, I agree with you. The stimulus is going to be complex, to say the least.
Tom Keene, Lisa Abramowitz, Jonathan Ferro. This is Bloomberg Surveillance. I'm proud to be a part of it. This is what the equity market looks like this Friday morning. Good morning to you all. We're shaping up as follows. I might be sleep deprived. I might be sleep deprived.
You're doing great.
And the more you're deprived of sleep, the more it sounds like you might be drunk. I'm not. Equity futures down 33. We're negative 1%. And the FX market, euro dollar 116.75, and a bond market that is unchanged. This is Bloomberg Surveillance live on Bloomberg TV and radio.
the Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Almost the end of the month, huge week ahead. An election, a Fed decision, a payrolls Friday, just around a corner. Here's your equity market. Down by 31. We're off by about 1 full percentage point, going into some economic data in the United States of America, which means one thing. Michael McKee's back with us this morning. Good morning to you, Mike. Let's get to the numbers.
Good morning to you, John. We're waiting now for personal income and spending. We've got a pretty good idea of what they're going to be because they were included in the GDP report yesterday, and so the economists have backed it out, but we're waiting for the data. Still a little slow to come in, however, and we're also waiting for the employment cost index, which has also not popped up on the screen yet. Remember the BLS and the BEA, everybody now releases everything on the internet. And we're not getting the numbers. I just got service unavailable in terms of the income and spending numbers. Income expected to come in at 0.4, and here it comes in double that, 0.9 for the month. In the month of August, it was down by 2.7%. So income's up significantly. Probably the drop in unemployment compensation that we saw last month falls out of the data. Spending up 1.4%. That is better than the 1% of the prior month and 1% forecast for the month. So it looks like we have a little bit of a better baseline going forward into the fourth quarter than people had anticipated. The other big number that comes out of this release is the PCE inflation figures, and those are what the Fed watches most carefully.
Yeah.
The PCE for on a year-over-year basis drops 0.1 to 1.4%. Well, actually, it stays at 1.4%. So it's 0.1 lower than we anticipated. That's the headline number, and remember, the Fed wants 2% on that number. The core year-over-year basis does drop 0.1 to 1.5 from 1.6%. So a little bit less inflation, which the Fed pretty much anticipated, but a little more spending and certainly additional income for people. The revision we're just seeing now is that personal income was revised down to a drop of 2.5% from 2.7. Tom, one more quick number, and that is the employment cost index, which is a quarterly number. At this point, comes in an increase of 0.5. That was expected, and that's what we saw last month.
We're going to stop the show here, Michael McKee, because this is really, really important. On the deflators, we saw not only the numbers tick down, but we saw the revisions come in as well. And, John, this goes right back to Chairman Powell and what David Rosenberg said the other day. Yeah, there's service dynamics, service disinflation, goods sprung up, maybe goods come back to some form of zero or even outright deflation. I mean, this is what we've got now. Within the lethargy, we have a disinflation, right?
We have a disinflation.
Me, Tom. You know, let me jump in, Mike. Maybe it's just the mood I'm in this morning. What are we arguing over? 50, 60 basis points on the PCE in the United States?
It's really not the basis.
Let me just finish. Let me just finish, Mike. CPI core in Europe right now is 0.2%. That's what a problem looks like. Yeah. I don't know if 1.5. I don't know if we should be obsessing over this like the Fed seems to be every single month.
No, I don't think the Fed is obsessing over it, John, and I don't think it's a problem. It is a disinflation, not deflation, and it is more the trend than the actual numbers. And it matters more to people in the fixed income markets in terms of your positioning for what you want to buy and sell. It isn't really an issue for the Fed at the moment. They do expect this to happen. It's much more of an issue, certainly, in Europe, and Christine Lagarde had to answer a lot of questions about their forecast for negative inflation, for deflation for a couple of months. So, yes, much more of a problem in Europe than here.
Are we going to have inflationistas through the winter? I mean, winter is coming, all the cliches. Is it going to be the winter of our inflationistas? Mike, are we going to see that? Worries about inflation?
I don't think you'll see too much of it. The greater concern seems to be that when we come out on the other end, especially if we get a stimulus package, especially if the Democrats come to power in January and we get a big stimulus package, there's a feeling we could see inflation down the road. And it could appear rather quickly. That's something we've seen as a theory in the past that hasn't played out, which is why the Fed seems fairly confident in letting the economy run hot for a while.
Mike, just to wrap up all of these numbers, the income and spending data edifies this idea that the consumer has been incredibly strong and much stronger than a lot of economists have been giving them credit for. And the idea that income rose so much more than expected is telling and hints at a stronger recovery. Does this give you the sense that balance sheets, household balance sheets, have much more ammunition to sustain a rally without more fiscal support for many more months or perhaps even weeks than economists are giving on?
Well, I'm looking for a number here that would give us a much more better indication of that. And you look at disposable personal income, it's up by 0.9%, same as the overall personal income numbers, and that's up from a negative 2.9% in August. So we're starting to see more money in people's pockets, and the question is, how willing are they to save that? I'm looking for the savings rate, which I haven't found quite yet here. We're waiting for that. I think we may have just gotten it here. Yes. Personal savings rate is 14.3%, a slight drop from 14.8%. We hit 33.6% in April when everybody started getting checks and started putting money in the bank and not spending it. But 14.3% is still quite high, and it does suggest that people have some dry powder that they can spend going forward. Wages, interestingly enough, up 0.8% in September. That's down from 1.4%. But remember, most of last year, we were around the 0.4 mark. So wages are still a little bit higher. This may have more to do with the fact that low-wage people have dropped out of the calculation, but it does suggest that those who are getting paychecks do have some money.
Michael, thanks so much. That was really, really outstanding, folks. There's a lot of movement there, a lot of dynamics about an economy in pandemic. Right now, Lindsay Piegzik joins us right now from Stifel. We're thrilled that she could join this morning. Lindsay, I want to go right to that. Michael McKee showing the oddities of the moment, a savings rate that is double-digit. That's not normal for America. What are the ramifications of that high savings rate?
No, it's certainly not normal. And when we see Americans squirreling away that type of cash, that amount of wealth, it really speaks to the uncertainty that the average American is feeling about their financial footing going forward. A 14% savings rate translates into over $2 trillion in accumulated wealth and accumulated savings that can be deployed out into the marketplace. But right now, consumers are looking out at the recovery. They're looking out at the prospect of a resurgence of the virus and potential further restrictions or shutdowns, and the consumer is very nervous. And in fact, rather than immediately spending that wealth, they're deploying that to their savings account and sitting on that additional savings.
Lindsay, just quickly, of course, the distribution for those savings not equal. Where in society is that money sitting right now, and how likely is it that it'll be spent?
Well, I do think there's a disproportionate amount of the savings that is being held at the top rung of the income ladder. But with forbearance, with generous unemployment benefits, there is a sizable amount of wealth that has been captured, even in the middle or bottom rungs of the income ladder. So yes, there is a little bit of a skew towards the top, but I do think that when we look at overall, the average American may be better off than they were pre-pandemic, or at least on somewhat stronger financial footing. So going back to a point you made earlier, I do think that this looming fiscal cliff that many are concerned about may not be quite as ominous as previously assessed because of that additional savings or that additional wealth that the average American is facing right now.
That's where I wanted to go. If we could game out how long households have to maintain spending or even just reduce it a little bit, perhaps to edify these forecasts for a blockbuster holiday season, how long do we have before we sort of hit the wall, where we either need more fiscal support or we actually see the slowdown that so many people have predicted would already have happened and yet hasn't?
Well, if we assume that the economy continues at this pace, the consumer does have several months to eat through that accumulated wealth that should carry us well into the first quarter, even independent of a fifth-round stimulus package. But we also have to recognize that the virus is far from contained, and that remains the #1 risk to the economy. Or should I say the policies aimed at stemming the spread of the virus remain the #1 risk. And if, in fact, we do see a resurgence towards the end of the year, leading to further restrictions, further lockdowns, resulting in further business closures, job losses, lost income, revenue, opportunities, well, we could see growth regardless of the savings or that wealth accumulation. We could see growth slow significantly or even fall into net negative territory, depending on the depth and duration of that rebound or that resurgence of the virus.
Lindsay, final question for me. I think it's the biggest question for any economist in the United States right now. Does this U.S. economy and this recovery go the way of China or go the way of Europe by year end?
I think right now the risk is that we see a similar scenario that was playing out in Europe right now. Again, that second round resurgence of the virus really undermining the improvement that we've seen July to September. That was a welcome step in the right direction, a record 30% bounce, but again, reflecting the fact that we're simply reopening the economy. So really emphasizing the power of reopening the economy, bouncing off of those low levels that we saw in the second quarter when businesses were forced to close and individuals were forced to stay within the confines of their home. And it really highlights the ongoing detrimental impact of keeping the economy closed should we see new policies force the same scenario as we head towards the end of the year.
And that's the issue right there. Lindsay, great to catch up with you. Good to hear from you. Lindsay Piegza there, Stifel, Chief Economist. I get to step away in just a moment, a little bit later today, a little bit later this morning. In about 30 minutes' time, I'll catch up with Mohammed Al-Arian, Queen's College President and Bloomberg opinion columnist. And I think, Tom, we've got to start right there. We've got to start right there on that very issue. Europe going one way, China going the other. Which way does the United States go?
Well, and again, depending on the election, depending on the stimulus, but far more, John, and I think this has been the theme of the week, has been the pandemic dynamics really trump all, no pun intended.
And they've started to bite big time in Europe, in this European equity market. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Let's wrap things up with a bit of price action for you quickly and whip through these markets. Equity futures down hard at about 2 a.m. Eastern on NASDAQ futures. We recovered just a little bit, and then we rolled over, just a little softness creeping back in 50 minutes out from the opening bell. Equity futures on the S&P 500, negative 28 points and down a little more than 0.8%. Everything counts. Tom, you've made this point and you're just dead on. This is a stock story this morning. You don't see much in foreign exchange. You don't see much in the bond market. You don't see much in crude after the big week we've already had.
Yeah, absolutely. I mean, I'm looking here, West Texas Intermediate, 36.00. Sure, it's down, but it's just a fractional move. It'll be interesting to see what happens to tech as sell side reaffirms what seems to be an optimism.
The opening bow this Friday morning, just around the corner. Good morning to you all. What a week ahead we've got coming up live on Bloomberg TV and radio. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. They weren't able to agree on a coronavirus relief package before the election. Now Nancy Pelosi and Steven Mnuchin are still battling over terms for a post-election deal. The Treasury Secretary accuses the House Speaker of refusing to compromise. Pelosi says she's waiting for Mnuchin's response to her demands. The path of the U.S. economy is less certain after record quarterly growth. Third quarter GDP soared 33.1%. That largely reflected a rebound in economic activity after widespread lockdowns earlier this year. Economists are projecting the U.S. economy will grow anywhere from below 3% to about 6% in the fourth quarter. The U.S. has set a record for its most coronavirus cases in one day. 89,000 cases were recorded. There's a jump in infections again in New York and New Jersey. Plus, there's a record outbreak across those Midwestern states. You can assume that ECB President Christine Lagarde has signaled that more monetary stimulus is coming. That's according to one of the bank's policymakers, Robert Holtzman. He spoke with Bloomberg.
This is a correct interpretation with some caveats. The one is, she also said it's very clear that we use the December projections and the information in December to make our decisions. What we've decided is to make preparations, to go through our whole portfolio and see in what area we need to recalibrate to be ready for December, but the decision will be based on December data.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The 2020 presidential election is in the home stretch, and a handful of states will decide who occupies the Oval Office. I'm David Weston. Join me for our second Swing State special as we turn our focus to Florida, Pennsylvania, and Michigan this weekend on Bloomberg Television.
Go out on the street and ask 9 out of 10 people. They will say they want to work from the office. And the fact the efficiencies are not even close when people aren't in the office because you get distracted with 100 of other things.
Good morning, everyone. Bloomberg Surveillance, Lisa Abramowitz and Tom Keene. Thrilled you're with us. John Farrell on assignment right now. Rob Felsen with us with Prudential. I want to get right into this because this is the topic and one of the topics of thinking into the weekend around all the crowded news. He is Vice Chair of Prudential Financial, Lisa, and Rob Felsen really simply is considering getting people back to the office, or is a permanence to this work from home. Rob, Lisa and I have heard 42 different opinions on this. What is the learning curve right now of people thinking about this? What's the thinking now versus what the thinking was in May?
Yeah, so Tom, I think the thinking is that we're not in a sprint, we're in a marathon, and particularly with the most recent data coming out, it looks that many companies, most I would say, are actually extending out even further the time that they think they're going to be in this remote environment. We've done that recently. We told our employees that won't be any earlier than July of next year. That we'll be looking to have them come back in any kind of material way. And I think that's a reflection of a couple of things. One is in a survey that we did recently, it indicates that actually remote work is working. It's relieving the stress that a lot of these individuals are experiencing from the pandemic. Child care, elder care, balancing work life, and doing it in a remote environment has actually helped to ease some of the pressure associated with that. And the second thing is that productivity has actually held up quite well in a remote environment. 60% of our survey indicated that their productivity is actually at or above where it was when they were at the office.
What I'm hearing, and folks, this goes to a great team of Bloomberg Surveillance worldwide. I really can't say enough about, you see the 3 or the 4 of us on air. Well, there's 40, 50 people behind us trying to make the sausage every day. And Rob, what I'm hearing is the employees actually feel they're working more hours at home than they were in the office ex-commute. Is that what your research shows?
Absolutely, Tom. Two things on that. One is there's 3 actually. There's been a blurring of the start and the end of the workday, and it's tending to start a little earlier and end a little later.
Really?
Two. In the survey, 65 individuals have taken 65% less vacation year to date than they did last year. And 3, on average, they're commuting an hour less every day, but 60% of that, they're reinvesting back into work. So it's not more leisure time, it's actually more work time.
Yeah, I will say, Rob, there was a story in the Wall Street Journal today, the lead of which was, what would you do with an extra hour each day? And the answer is, for many people, work more. Basically, this is unsustainable going forward. A lot of people, if you talk to them, they're medicating with alcohol in the evenings. They're wondering what they're going to do with their children. They're not necessarily feeling the satisfaction that comes from working from home when it comes to this beautiful image of not having to commute. Do you see this as the new reality, or do you see this as people hanging on with all that they can, given the fact that they don't have options to go on vacation anyway, and it is okay for now, but then they're going to go back to the office?
Yeah, listen, it's a grind. There's absolutely no argument about that, and that comes through our survey as well. And, while remote has helped with the stress associated with the pandemic, the reality is that they're still very stressful for individuals. I think a couple thoughts on that. One is, if I think about the productivity gains that we're getting, and how much of that can be retained long term, I actually think there is a real productivity enhancement here. There was an acceleration in, what we call the future work, the adoption of technology, the digitization of processes out of necessity. And that's going to be sustainable. But the remote, and then secondly, the remote piece of it, our surveys indicate that 3/4 of the individuals that were surveyed indicated that they would like to continue to have some element of remote work on a go-forward basis. Now, I don't think anyone wants to be fully remote on a go-forward basis, or most people don't want to be fully remote on a go-forward basis, but both our internal company surveys and the external survey indicate that people have gotten used to this remote and think it's actually an enhancement to work-life balance, and they'd like some element of that going forward. And I think that when we return to the workplace, therefore, it's going to be a very different experience and a very different place for individuals, because it will, I think, have hybrid models of remote on a go-forward basis that look very different than what we had pre the pandemic.
A lot of people would agree with you, Rob. I want to go back to something that Bruce Flatt, who is the CEO of Brookfield Asset Management, said, and it was what we heard earlier in this segment, where he said that if you go on the street, you ask 9 out of 10 people, they want to go back to the office. They want to have some sort of communication face-to-face with colleagues. Do you feel like, from your conversations and your research, people want to be in urban centers, even if they're not going to be necessarily going to work every day? They want to be able to see and physically experience one another and the world at large? Or do you think that perhaps this is wishful thinking by a real estate investor?
Well, it is a real estate investor, so a good note on that. Two points. One is right now in the pandemic, our surveys are not indicating that people want to get back into the office place. Actually, our own internal survey, 87% of our employees said we do not want to go back. And a similarly high percentage of individuals in our external surveys have indicated that they, at this point in time, don't want to go back. Now, post the pandemic, do they want to go back into the workplace? Absolutely. But again, in a modified fashion, I'll refer to our own internal survey. We have, before the pandemic, about 21% of our people worked on either 3 or more days a week remote. When we did a survey during just more recently post the pandemic, 3/4 of our employees indicated that they want to be remote 3 or more days a week. 92% of our employees said they want to be remote 2 or more days a week. Now, there was a small percentage that wanted to be fully remote. So I think people miss the human interaction associated with being at the workplace. Absolutely. That doesn't mean they want to return to a 5-day showing up in the office.
This issue's not going to go away, Rob. We would love to have you on again. Rob Felsen, with decades of experience in real estate, working, of course, with Prudential Financial, their commitment to Newark, New Jersey. He is their vice chair. Lisa, I look at the tape, and again, it's an ebb and a flow. Right now, equity's improving -30 to -21.
Yeah, but really what you've highlighted is the most important part of this story. Basically, this is a little bit of the sheen coming off big tech as it has been since the peak in September. This isn't the broad-based sell-off that perhaps we saw Wednesday, and you're certainly seeing that with not much of a bid into bonds, not much of a bid into gold. Hard to say what this day is.
Also, I'd note on the idiosyncratics of the moment, Lisa and I always end on idiosyncratic themes, and that is Turkish lira now breaking out to new weakness. It's been quiescent over the last hour or so, and that is not the case now. It is truly, and I use this word with respect to the people of Turkey, an unimaginable 8.37. At some point, that will be a very large theme. Futures -21, Dow futures -192, currencies, the dollar a little bit weak is what I'll call it. Farrell, John calls in from London and says, quote, sterling 129.72.
Exotic. Go for the exotic.
It's an exotic, yes, an exotic. Pound sterling.
Woo!
John Farrell is exotic. Speaking of exotic, Edward Hyman, Evercore ISI in the 3 o'clock hour. Stay with us on Bloomberg Radio, on Bloomberg Television.
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. Equity futures down 0.7%. We begin with a big issue. Thick fog building on the horizon. Big tech delivering blowout results, selling off after clouding expectations into year-end, fueling steep declines and injecting more volatility into a jittery market gearing up for a massive week ahead.
All of these very binary events coming.
We need to get through U.S. elections.
The U.S. election.
The election is certainly driving the short-term volatility.
We need to determine the stimulus.
If we can get a material expectation for large infrastructure spending.
The size and how broad its reach is going to be.
If we have a blue wave, we'll get lots of stimulus.
That can change the equation for growth expectations.
Where we go from here,
until we get some good news,
will be dictated by the events of the next several weeks.
The next few weeks, the next few months don't sound good.
This market is going to stay choppy, it's going to stay very volatile.
November is setting up to be a very hectic month.
There is a lot of anxiety. There are a lot of jitters.
A lot of jitters this week, that's for sure. Bloomberg's Kaylee Lyons joins us now. Hey, Kaylee.
Hey, John. Well, we have about 30 minutes to go until the cash open, and we do look set for a negative open, though I should note we are well off the lows of the session when it comes to futures. S&P futures off now just around 25 points. The deeper pain, of course, is in the NASDAQ, which is down, futures down about 100 points after those disappointing results from many of those mega cap stocks, Apple, Amazon, Facebook, just not living up to notably high expectations. Alphabet, of course, the exception to that rule, but still its gains this morning not enough to offset the losses from its peers. And of course, on top of tech earnings, John, everything that was true when we saw that sell-off on Wednesday is still true this morning. Still record virus cases, still no stimulus, and still uncertainty around an election that is now just 4 days away. That all is playing into risk appetite or the lack thereof this morning. What's interesting, though, is when you look cross-asset, you don't necessarily see that lack of risk appetite reflected elsewhere. Once again, even though futures are lower, treasuries go nowhere, flat for the U.S. 10-year yield. The dollar not getting any kind of safe haven bid. You are seeing gold up about 1%, but really it's that 60-40 portfolio I'm focused on here, John, just not doing what it's supposed to be doing. Actually, stocks and bonds are set to end the month of October lower. And finally, I want to check on just one more risk asset, and that is oil. It's roughly down about 0.9% today, and it is down 10% on the week over the course of the past 5 days. It's the worst 5 days since all the way back in April, and that you can't chalk it up to big tech, just a disappointment, John. That is all about the virus, concerns about growth, and of course, demand, John.
Brutal week for crude, 35 handle. Katie, thank you. We'll catch up with you later. Uncertainty continuing into next week, and what a week we've got coming up, with investors facing the U.S. election on Tuesday, a Fed decision on Thursday, and the jobs report coming on Friday. Mohammed Al-Arian of Queen's College warning about the economy ahead of those numbers, writing in Bloomberg Opinion the following: hopes of a V-shaped recovery for the global economy have given way to a realization that the pace of growth is losing steam. The more countries repeat the cycle of unsustainable reopenings, the greater the economic scarring, including rising bankruptcies, longer-term unemployment, and increased economic insecurity among households. Mohammed joins us now. Mohammed, as always on a Friday morning, fantastic to catch up with you, sir. It's my question of the moment, really. China going one way, Europe going the other, and a question mark over the fate of the U.S. recovery. Where do you come down on that now, Mohammed?
It is the hardest one, John. It's clear that Europe, most of Europe, will have a double-dip recession, and that's really regrettable. And hopefully this time around, people will learn how to live better with COVID so that we can reopen in a more sustainable fashion. China has controlled it. My own gut feeling is in the US, we will see the same problem with cases, hospitalization, test and trace system being overwhelmed, and household behavior is going to become more risk averse. But we are not going to see different states jump to restrictions as quickly as we saw Germany, for example, do so. So you will get the slower economic activity because of people's behavior, not because of lockdowns.
So consumers to disengage regardless of restrictions. So for the investor then, Mohammed, this is really important because you got the feeling this week that for some market participants, even though consumers were disengaging in Europe, particularly in Germany, they waited for the restrictions to take the longs off. Now, Mohammed, I want to understand from your perspective the best way of processing this situation, the signposts that you'll be looking at to navigate this market through the next couple of months as we go deeper into winter.
So I think you've got to differentiate between the economy and the marketplace. The economy is about looking at the high-frequency data, the very high-frequency data, mobility, restaurant bookings, credit, the information we get from credit cards. There's a ton of information, public information available on all this. And to get a feel to how the consumer is reacting and how different states are going to react in terms of restrictions. That is what's going to matter. And remember, John, the hardest thing for markets is dealing with a shock that is viewed as temporary, but you're not quite sure when it's going to be reversible. We do very well when it's temporary and reversible. We do okay when it's permanent because we know what we're looking at. But this one, we think is temporary, but we're not sure if it's fully reversible or not. And that's what makes it tricky. But the marketplace is going to be about central banks still. Do investors still have faith in central banks? You saw yesterday, it was like watching a movie over and over again. Sell off on Wednesday, ECB responds on Thursday, responds by providing even more guidance than what the market expected, and we trade up. Will we see that cycle repeat next week when the Fed delivers its verdict on what's ahead?
Before that, we've got to navigate the politics as well, Mohammed. A red headline crossing a Bloomberg right now. Early voting in Texas has surpassed the total turnout from 2016. Mohammed, it's a remarkable turnout. We keep saying it's 4 days to go. It's not 4 days to go until the election. It's 4 days until this election wraps up. We've seen so much voting already. Mohammed, it's the politics on top of the economics, on top of the monetary policy that people are struggling with right now. Just this idea that the politics defines the fate of the fiscal effort as well. Mohammed, how key is the next week with regards to that?
So, John, I don't know, honestly. I think it's less important than most people make it out for the marketplace. I think what the market wants to know more than anything else is, will we have a functioning transition? If we have a transition, and if we don't have a functioning transition, will the government or the presidency that prevails in January have a divided Congress or not? Okay, that's the big question, the two big questions marked for me. If we don't have a good transition, smooth, one way or the other, and if we don't have and if we end up with a divided government, then the economy is in deep doo-doo, because we're not going to get the sort of stimulus we need. We're not going to get the sorts of structural reforms we need.
Earlier this week, Mohammed, Mr. Dudley, formerly of the New York Fed, I'm sure you know him well, talked about the lack of firepower the Federal Reserve had. Now, of course, the Federal Reserve can always do more, but I think the point he's trying to make is just the diminishing marginal returns of that additional dollar of Fed stimulus isn't going to do much. Now, it might not do much for the economy. Mohammed, do you think it can do much more for the market?
It's all about behavioral issues. It's all about condition. What we know very clearly away from the marketplace is every incremental dollar of central bank liquidity has fewer benefits, higher cost, higher unintended consequences. I think that is clearly established, that is the equation. But the marketplace only cares about one thing, John, and understandably, I sympathize, which is someone else going to buy what I'm buying? And once you have the mentality that the Fed with a printing press in the basement is buying what you're going to buy, you start expanding your hopes for what the Fed is going to buy. And that's the mentality that's in the marketplace. It's very deep. I think it's not realistic. The Fed is not going to be buying equities. But try to convince that to a marketplace that has been conditioned over and over again to expect ample and predictable Fed support.
Mohammed, do you think the bar for capitulation is higher this time around than maybe it was in March because of what's on the horizon now versus March? Now we're talking about vaccines, we're talking about more fiscal effort coming from Washington, more monetary policy effort coming from the ECB as well. Does that make a difference, Mohammed?
It makes a huge difference, as does the fact that we came back so quickly after the March 23rd low. So what has happened is people are willing to buy the dip quicker than they should otherwise based on fundamentals, and people who would be pressuring this market or are shorting this market are largely on the sideline. So if we do get an adjustment, it will be a big one. And that's why I said, look at the duration of any sell-off, because the longer the duration of a sell-off is, the greater the damage to the conditioning that you should be buying this dip, that there is no alternative to equity, and that you're really afraid of missing out. The three things that have really led this market. So the duration of any sell-off is as important as the magnitude of that sell-off in impacting investor conditioning.
Mohammed, fantastic to catch up with you, as always. I know you're super busy because of the time change here in the UK. Mohammed Al-Erin there, the Queen's College president over at Cambridge. In a market right now, equity futures are down 25, off by 0.75%. That's the bad news. The good news, if you're up at 2 a.m. Eastern, I was, but I'm in London, so I have an excuse. This equity market was down much, much harder. The story is in tech with your movers. Here's Abigail.
Well, John, big tech under big pressure today. Apple, Amazon, Facebook, and Twitter all beating on the surface, but beneath the surface, factors that investors don't like. Starting out with Apple down 4%. They missed iPhone estimates down 20%. China down 29%. China's a big consumer of the higher-end phones, that iPhone 12, not in this quarter, but they didn't provide an outlook, so investors really not liking that. Amazon also beat, but their fourth quarter sales, the bottom of the range, not really, exactly what investors wanted for a stock, up 100% out of the March lows. Facebook's quarter was good on strong ads and spending outlook, a little bit of a concern, so you see that stock down just 0.5%. Twitter, though, plunging, down 15%, heading to its worst day since March 16th. They beat on the surface, but again, their user growth outlook, not great. In the third quarter, they added just 1 million new users versus adding 20 million in the second quarter. Investors not liking that, especially given the fact that you have the election and folks on Twitter. However, where we do have a bright spot, John, that's all about Alphabet in a class of its own, soaring up 7.5%. Clean beat right across the board, helped out by ad spending. YouTube heading to its best day since March 13th. As for the futures, John, Alphabet less than 4% of the S&P 500. Those other four names, a combined 18% of the S&P 500. That is why we are under pressure today, John.
Apple, 13% of the NASDAQ 100. Abigail, great work as always. 20 minutes into the opening bell, 20 minutes away rather. Coming up on this program, presidential hopefuls making their closing arguments with just 4 days to go until we wrap up this election. That conversation up next with Citigroup's Robert Buckland. Looking forward to that next on this program. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen and that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We are creating the greatest red wave in the history of our country.
We literally are going to change the course of this country for generations to come.
There's never been an election more important.
We need a president who's going to bring us together, not pull us apart.
On November 3rd, we must finish the job and drain the rest of the swamp.
This country can't afford 4 more years of Trump.
We are going to keep on winning, winning, winning.
It's time to stand up, take back our democracy.
A vote for Republicans is a vote for the great American dream.
You hold the key. If Florida goes blue, it's over. It's over.
When we win, Florida wins and America wins. It's very simple.
President Donald Trump and former Vice President Joe Biden speaking from Florida, where the latest polls show the president trailing by 4 percentage points with just 4 days remaining of this election. Both candidates returning to the Midwest today with scheduled events in Michigan, Minnesota, Wisconsin, and Iowa. Let's bring in Kevin Cerulli, Bloomberg Chief Washington correspondent, for more. Kevin, just a few more days to go, sir. Good morning to you. What's on the agenda today?
Well, I was just looking at the Scranton newspaper in Pennsylvania online, and I can tell you everyone's talking about all of the various events that President Trump as well as Joe Biden are going to be holding in this key, crucial battleground state. You look at the latest polls, Joe Biden with a lead, according to the polls in Pennsylvania, but I was speaking with Republican strategists in the state yesterday, Jonathan. They feel that this race is much closer than the polls indicate. A confluence of two competing issues. Philadelphia under a curfew, National Guard arriving today to deal with the protests, some of the racial unrest that we've seen in that portion of the state in this week, given what's been going on in that city. Then you've got the energy issue. President Trump hoping that turnout in the southwestern portion of the state will really come out to support him as a result of the fracking issue. Unknown variables in Pennsylvania. Head on down the coast to North Carolina, another key crucial state. The Trump campaign outlining their path to the White House and re-election in public comments. 5 of the 7 paths, Jonathan, that they've outlined have winning North Carolina, a crucial state. Democratic governor, okay? A senator who's up for re-election in Tom Tillis, a Republican, up against a Democratic challenger, Cal Cunningham. That's incredibly close. So for a host of different reasons, the way North Carolina goes could really indicate if there's who's at the top of the ticket for the White House, but also if there's going to be a blue wave and who has control of the Senate.
Kevin, talking of turnout, we've already surpassed 2016 in Texas. We've already surpassed 80 million people voting. I mean, we sit here, the cheat guide's always the same. It's always about turnout. Every time we have any kind of election anywhere, we know the turnout. Sky high, Kevin. What does it mean?
Well, and I think that you've been incredibly forward with this. And it's deeper than just the turnout number, but it's the demographics and the data of where that turnout and the early indications of the mail-in votes are coming from. Democrats feel emboldened by this. Look at Harris County in Texas, where turnout and early mail-in voting has skyrocketed. That, of course, is near a major city, Houston. And so they feel that if the early numbers in cities are indicative of a large turnout, that will mean that more Democrats are going to vote. However, I would caution against this, because as much as the president has spoken out against casting your ballot early or mail-in ballots, many Republicans across the country, maybe from a matter of convenience, would prefer to do so. It's going to be really interesting. We might not have a result on Tuesday night, given the patchwork of different rules at the state level in terms of how to count those votes. Something like a North Carolina and Pennsylvania, for example, it gets incredibly interesting in terms of the dynamics of when those early mail-in ballots are going to be counted. We could be looking at, if it's a close electoral race, we could be looking at 1 or 2 states at the second half of next week without a clear winner of who wins.
Kevin, thank you. Great work. Busy week ahead of you. Kevin's already there of Bloomberg. Citigroup's Robert Buckland writing that investors are preparing for any outcome following the surprising results of 2016, running the following. The market generally believes the polls and expects Biden to win, but still fears a contested election. Shares fell 11% in 2000 between the election and the final result in January. Robert joins us right now. Robert, build on that, the degree to which we are conditioned by what happened 4 years ago.
Yeah, I mean, the markets didn't cover themselves in glory, really. First of all, they never saw Trump winning. And then secondly, I think the markets, investors were too cautious on what the impact of him winning would actually be. So we're wary at the moment in markets. And definitely what we've learned is not to count Trump out.
Are you wary of what it would mean as well, Robert? Are you wary of that too? Because quite clearly we've established quite a strong consensus about what a Biden win would mean. Are you wary of that too?
In terms of, am I wary of Biden winning and what that might mean for markets, or Trump doing better than we expected?
The former. Let's focus there just for a moment. It's pretty clear that 4 years ago, many people thought that if President Donald Trump became President Donald Trump, it would be risk off. It certainly wasn't for the few months after that. This time around, we're looking at a blue wave. 2 months ago, that was negative for this market. 2 months later, it's a positive. What is it, Robert?
Yeah, I think there will be a bit of a relief rally. I think if you want to be positive, what you focus on is the likely increase in infrastructure spend, right? We're hearing potentially $3 trillion of infrastructure spending, and equities will like that. Anything that helps to boost growth is generally helpful for equities as an asset class. But on the counter side, the markets will then start to worry about how that's going to be paid for. And in particular, what my clients are asking about is the potential hike in corporation tax.
How much does this and next week play into the long China call that you're looking at the moment, Robert?
Yeah, I mean, what we like about China and Asia in particular is the way that they've got COVID under control and the economies are functioning relatively normally. So I like that one. Of course, what I don't like getting involved in China, Korea, Taiwan is the potential for further trade wars. The word is that those trade wars would be less aggressive if the Democrats were to win. So that's kind of a bad thing that was holding me back from being positive on Asia that might be slightly less of a bad thing.
Robert, do you think the traditional China proxies work in this environment, given what we've seen this year? I'm thinking about Australia. I'm thinking about the DAX. You mentioned South Korea as well. Do you get that positive spillover that we're used to out of this China recovery?
I always sort of say to people there are 3 ways you can play China, and we all know the story is good and growth is better than it is in the rest of the world. And now we've got this extra component of them getting COVID under more control than we're seeing elsewhere. I always think there are 3 ways. You can either buy China direct, you can buy resource stocks, particularly the mining companies. Remember, over 50% of metals consumption nowadays is in China. And the third thing is to buy companies elsewhere in developed markets, I don't know, luxury goods stocks in Europe and so on, who do big business in China. Right now, my preference is probably for buying the Chinese market direct or the mining companies. I think the other companies that do business in China look a bit expensive.
Robert, great to catch up. Really appreciate your insight. Robert Buckland there on this market. Thank you, sir. 7-8 minutes away from the opening bow with equity futures lower. Coming up on this program, the analyst action you need to know. That'll be next in our morning calls. And later, we're digging into big techs, big earnings after the bow yesterday. This morning, Apple down. Up later, D.A. Davidson's Tom Forday. Looking forward to that conversation. With equities rolling over, in Europe, it has been tough, tough, tough. In the United States, not a whole lot better for the equity market longs. Futures lower. This is Bloomberg. 5 minutes out from the opening bell and setting off on a journey to wrap up this crazy trading week. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin with Piper Sandler raising its Amazon price target to a very specific 3903. They have an overweight rating. The analysts expecting the pandemic to fuel blowout results in the fourth quarter. That stock is negative 1.4%. Your second call from JP Morgan raising its Facebook price target up to 330, an overweight rating. The analyst citing a strong rebound in advertising revenue across all regions. That stock also negative, down by 1.36%. And your third and final call comes from D.A. Davidson raising its Apple price target up to 133. With a buy rating, the analyst citing optimism around the rollout of Apple's new 5G iPhones. That stock, negative 4% going into the open. Around the opening bell, we'll be speaking with the man behind that call, Managing Director and Senior Research Analyst Tom Forday, joining this program next. From London and New York this morning, good morning. With equities lower, this is Bloomberg.
Ada 3 kelompok pengungsi tersebut yang sudah berpencar arah. Kemudian kami dari Polsek Banda Sakti berkoordinasi dengan perangkat desa Kampung Jomblang melakukan upaya pengumpulan secara persuasif serta minta tolong kepada warga. Alhamdulillah warga yang terpecah semuanya berkumpul.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
25 seconds away from the opening bell. Here's the price action. Futures down 21 on the S&P 500. Coming into Friday, worst week since June. That's what we're set for, down 4.5% on the S&P 500. In the NASDAQ, futures negative 0.9%. Overnight, 2 a.m. Eastern, we were negative 2%. The story in the market over the week, down about 2.92% on the NASDAQ 100 on the week. Worst weekly loss since September. There's the open. Switch up the board, get to the bond market. What a week we've got coming up next week. An election, a Fed decision that shifts out to Thursday, and a payrolls Friday coming up too. Your bond market just does not want to participate with the risk aversion in equities. Yields are higher by a basis point to 0.8366%. Crude is lower. This week has been ugly, ugly, ugly. Down 1%. 35 handle on WTI. Bloomberg's Anne-Marie Horden whipping through the numbers through the week, and it has not been pretty. In the FX market, euro-dollar down for 4 straight days in the FX market coming into Friday. Euro firmer this morning. Euro-dollar 116.87. The 100-day moving average around about 116.50 for those of you interested. So that's the cross-asset picture. Let's get the movers at the opening bell of the market desk. Here's Abigail.
John, well, the big story this morning is big tech under big selling pressure. Apple, Amazon, Facebook, Twitter, they all beat on the surface, but beneath the surface, nuances that investors are not liking. Relative to Apple, they missed iPhone sales estimates. That stock down 3.4%. Amazon's outlook not as great as folks had expected. Facebook, their spending outlook a little bit of a concern. And then Twitter, their new user growth just not up to par. For stocks priced to perfection, all these stocks up between about 40 to 70% on the year. They did not deliver perfection. Investors selling them today. Where we did get a great quarter, though, Alphabet, those shares popping here on the open, up at this point about 7%. They beat, a clean beat, really helped out by ad sales. That stock heading to its best day, John, since March 13th, but on the week, not so much, at least for the group of these stocks. The New York FANG Index on the week is now heading to a weekly loss of about 2.9%, the worst week since the middle of September. In fact, the first down week in 7 weeks. Really brutal selling pressure here from big tech. Let's see whether or not the day can change it. But the sellers are out this morning on big tech, John.
Apple at the epicenter of that, as you've pointed out. Abigail, thank you. On the week now, down by 4.87%. If we closed here right now, it would be the worst week on the S&P 500 since March 20th. It's been that long, and the move lower has been that hard. At the open, about 2 minutes in, it's a mild day of losses, but tech leading the decline. So many earnings over the last 24 hours, particularly from the biggest names in this market, the biggest names in the business. For more, I want to bring in Bloomberg's Sarah Ponzek. Sarah, you've written about this extensively through the week. If you don't beat, then give me the fuzzy, warm forward guidance on top of that. Even if you do that, this market might punish you.
That's exactly right, and we are seeing that play out this morning, extending from yesterday after the close. I'll kick it off with an excerpt from David Bahnsen over at the Bahnsen Group. He put it very well this morning. He said, none of Thursday's tech earnings results were bad, and some were spectacular, but the market is reacting negatively because when something is priced for better than perfection, it becomes pretty hard to live up to those expectations. If we take a look at net income and revenue for the major tech companies that reported yesterday evening, there you can see we saw revenue gain across the board. The largest increase over at Amazon with a boost of 37%, the smallest at Apple, 1% gain. iPhone sales did miss at Apple. They didn't give true guidance, but we're seeing that hit this morning, even as we see revenue gain across the board. So as it says, maybe the problem is just perception. If we take a look at these sales in aggregate, sum them up, what do we see? Well, we see the second highest sales on record for these companies in aggregate. There you see it right there, $228.3 billion. That is not a small number by any means, still delivering on the sales side of the equation, but the shares just falling this morning. At the same time, let's zero in on Amazon because we still saw unbelievable growth at AWS, but Amazon did warn about profits, especially with spending eating into profits due to COVID-19. So if we really do zero in on Amazon, we saw AWS sales rise 29% to $11.6 billion. Now, this is the 23rd straight quarter in which Amazon has posted sales growth of more than 15%. However, we also did see a steep rise in shipping expenses. So the question becomes, what happens next for tech? September 2nd, does that mark the top for tech near term? We have heard this expressed from the likes of David Einhorn, for example, who was saying that tech now looks to be in a bubble. Over the last 2 months, we have seen tech underperform, a major change from what we saw in the beginning of 2020. You see that right here. If you look at the NASDAQ, the S&P, and the Dow over the last 2 months, the NASDAQ is actually your worst performer. But keep in mind, in 2020, the NASDAQ's still up about 30% or so. The S&P just up 2%, John.
Zara Ponce, thank you very much. Remember, it wasn't just tech that topped in early September. The dollar bottomed around the back end of August, the start of September. Aussie yen, that great proxy for growth being the Aussie, risk aversion being the yen. Aussie yen topped out around the back end of August, the start of September as well. Crude, post-pandemic, that's where it topped out too. A lot happened in that moment, and we haven't recovered since. We mentioned Apple down by about 4% in the early part of the session, leading the declines in the S&P 500 following those earnings. D.A. Davidson's Tom Forte maintaining his buy rating on Apple, raising his price target to 133 and writing the following: "We believe Apple's first lineup of smartphones on 5G networks are better positioned than investors completely appreciate." Tom joins us now over the phone. So Tom, let's start there. Why do you think that's the case?
Yep, so first off, thank you for having me on, and a beautiful explanation of the uncertainty leading into the election. So I think it's the case, and I think the quarter is misleading because the September quarter had no new sales for the 5G iPhones. There was some color on how they're performing initially, but I think the September quarter, you could almost throw it out for Apple. And when you think about all the setup, when you think about wireless carriers wanting to support the billions of dollars they're investing in 5G, when you think about consumers spending less money on travel, less money on food away from home, and therefore having more discretionary income to buy the next iPhone, when you think about consumers stuck at home and leveraging really the Wi-Fi and not 5G, I think this all sets up incredibly well for Apple, and I would take advantage of the pullback.
Tom, can you walk us through where you think we have seen some pull forward in the Apple earnings in Q2 and maybe the give back in Q3, and where you still see the pent-up demand? Because there seems to be some discussion around that. I think for the bears on this name right now, they might say we've had the pull forward. Never mind the pent-up demand. We had the pull forward at a really tough time for this economy. We had a great Q2. That's why Q3 started to look rough, and maybe Q4 will too. What's the pushback there, Tom?
So excellent question. I think this really applies to Logitech. So Logitech had 75% sales growth in the September quarter, and historically they don't grow at that kind of level. And Logitech is the largest hardware partner of Zoom. So the question for Logitech and for Apple is, do you need another webcam over the next 12 months? Do you need another laptop over the next 12 months? And I think with 1 billion consumers working remotely and 1 billion consumers learning remotely, there are enough incremental new buyers that the answer is yes. But perhaps for those who bought that new laptop, that new webcam, they don't need one. So there was some element of pull forward for Apple on the laptop and tablet front.
Tom, just a final question for me, because I know you've got a super busy morning. What happened in China, and why is still constructive on that story?
Excellent question. China was down well in the double digits, and simply put, the September quarter a year ago had the next generation iPhone sales. This September quarter did not. Clearly, the Chinese consumer waited for the new lineup of devices, and that's what I attribute the weakness in China to. And I think that'll course correct in the December quarter with the new iPhones out.
Tom, it's going to be a busy November and December for that company. Let's see if they make it up. We'll catch up soon, that's for sure. Tom, I'll let you crack on. Busy day for you, as I say, for the Apple analyst this morning. Tom Forte there on the latest. That stock is negative by about 3.8%. Tough week for energy, given where crude's been trading, heading for its biggest monthly decline since March, with some of the industry's biggest companies reporting results and providing a pretty grim outlook over the last few days. Here's Scarlett Fu.
Yeah, John, big oil's in a defensive crouch because, frankly speaking, its economics are awful. You've got cratering demand plus an oversupply in oil. So companies like Exxon and Chevron are focusing on what they can control, and that's reducing spending. They're cutting CapEx. Exxon, for instance, now budgeting as little as $16 billion next year versus its pre-COVID plan of $35 billion. And both are planning to slash up to 15% of employees. Chevron sees severance costs reaching $500 million in the fourth quarter. At the same time, they're doing everything they can to preserve their dividends, and that means taking on debt, increasing leverage, and divesting assets. And this is all showing up as more red ink. Before 2020, ExxonMobil had not posted a quarterly loss in 3 decades. Now it's lost money every quarter this year. And on an adjusted basis, Chevron actually eked out a profit because of rising diesel sales. Increased freight is the reason there. But you can see that on a GAAP basis, it posted another quarter of loss. According to Bloomberg Intelligence, Chevron's purchase of Noble this month puts it in a pretty good position in the 4th quarter, and it should be better positioned than its peers. But overall, when you look at the price action, energy is the worst performing sector this month, this second half, and this year, and today's decline really just an extension of that. Investors are left wondering what's next, how much worse it'll get. Will the dividends be the next to go? And Exxon gave us a glimpse of what could happen. It's finally admitting that it may need to write down the value of some of its assets. We're talking about the nat gas assets that it purchased from XTO back in 2009 by up to $30 billion. That follows similar moves from the likes of Royal Dutch Shell, BP, and Chevron. So it's easy to see why, as you always put it, energy seems to be at the bottom of the pile on a daily basis.
Continuously. Scarlett, thank you so much. WTI, 35 handle. Brent, 37. The market down 0.4% on the S&P. It's a muted move compared to what we've seen through much of this week. Abigail Doolittle has got more of the movers. Hey, Abigail.
Hey, John. Well, let's return to the big tech movers because that is really continues to be the big story, even though we are off the lows. Now, Apple and Amazon really pressuring the index, the biggest point drags, those big weightings, and they put up, frankly, some disappointing quarters from a nuance perspective. Apple, they, of course, beat on the surface, but beneath the surface, they missed iPhone estimates. China down 29%. They also failed to provide an outlook once again into the all-important holiday quarter. So investors not liking that. Amazon down 3%. They beat, but their outlook a little bit tepid. So for stocks that are up so much this year, up more than 50% on the year, investors wanted perfection. They did not get it. And that weakness bleeding into other areas of the FANG complex. NVIDIA, the high-flying chip company, down 1.3%. Tesla down 2.2% in sympathy. Where the real weakness is, though, John, if we take a look at it, Twitter over the week, it is down sharply, absolutely plunging. This after, of course, their new user growth disappointed in the 3rd quarter. They added just 1 million new users versus 20 million new users in the 2nd quarter. Despite the election, investors wanted more. That stock absolutely nosediving, John.
Abigail, thank you. Coming up on this program, House Speaker Nancy Pelosi and Secretary Stephen Mnuchin back to playing, guess what? The blame game. That conversation coming up next with Invesco's Christina Hooper. 12 minutes into the session, equities lower by 0.6%. Something to ponder. Are you a seller on the cases increasing, or are you a buyer on the policies being introduced to correct course? Think about what happened back in March and think about what might happen this time around. Any different? We'll discuss that next. From London and New York, this is Bloomberg.
Just days away from the most critical election in U.S. history and its only democracy at stake. From electronic voting machines to misinformation and fake news and political advertising on social media, is the tech industry ready for its biggest test yet? I'm Emily Chang, and we'll be focusing on these issues all week on Bloomberg Technology in a special electioneering series. Tune in 5 p.m. Eastern, 2 p.m. Pacific on Bloomberg Television.
De esta manera me gustaría decirle a los empleadores que fueran más humanitarios con sus trabajadores, que les hagan valer sus derechos.
Y estábamos viviendo en dos casas, en unas 50 personas y en la otra otras 50. En cada casa había 5 habitaciones. En cada habitación había de 3 a 4 camas abarrotadas. Vivíamos de 6 a 7 personas. Un baño para cada habitación y una cocina para todas.
hospital. Al salir, nos avisó una compañera que ya nos habían reportado a migración.
Gracias a Dios ahorita de salud yo estoy muy bien, pero en lo moral no estoy muy bien, porque a causa de esta enfermedad yo perdí todo, perdí mi trabajo.
Yo creo que mi caso resulta un gran problema de cómo las personas migrantes estamos en riesgo de explotación por parte de los empleadores.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
You are about 15 minutes into the session in New York City, so this is what the session looks like. Up 0.7%, down rather on the S&P 500. We are down on the Nasdaq as well by 1.34%. Leading the losses, Apple. After a disappointment in yesterday's earnings, that selling continues into this Friday morning. Good morning to you all. The blame game continuing in Washington with prospects for a stimulus deal quickly disappearing. Speaker Pelosi placing the blame on a Trump administration and renewing calls for another stimulus package.
We have to ask, we're at a fork in the road. What we did in the CARES Act and the following, the subsequent legislation for PPP that put money into the economy. Now people are coming, that's going to wear off and we need another infusion. So it's not a question of we don't need it, it's a question of it proved that it worked and now we need it more.
Secretary Mnuchin responding in kind, calling it political stunt and tweeting the following: I woke up this morning and read Speaker Pelosi's letter to me in the press. Enclosed is my response. Her all-or-none approach is hurting hard-working Americans who need help now. Let's bring in Bloomberg's international economics and policy correspondent, Michael McKee. Mike, we've all struggled with this back and forth, the political posturing over the last month or so. Let's just start with this question. You've gone through the economic data. Is this an economy that looks like it still needs a lot more help?
It's not clear yet, John. It's starting to look like it doesn't on a macro sense, but maybe on a smaller sense. So the idea that the two sides are talking, I suppose, is good news. The bad news, it's on Twitter, which never really brings people together. Pelosi says they are still hopeful for a deal. They're just moving the time frame. Are you ready for this? By the end of the year, she says. Pelosi's argument is that the economy is slowing down and that we need to get some help to people immediately. And let's clear the decks before the new administration and Congress come in. The economic calculation that you just mentioned, though, with the virus still raging, new record cases, we're going to see more business closures, more jobs, layoffs. But the data we saw this morning suggests we're still okay because incomes rose twice what was forecast, 0.9%. And look at the savings rate. It's still very high at 14.3%. There is some ammunition there, at least on a macro basis. The political calculation, if Donald Trump wins and the Republicans control the Senate, what changes in these negotiations? If, as is more likely, maybe Joe Biden wins and the Democrats take the Senate, then do they want to wait for January when they have more leverage? So the bottom line is kind of in terms of stimulus, keep your expectations low. You won't be disappointed. The Fed will be disappointed without fiscal help, of course. They have to meet on Thursday. It's pushed back a day because of the election. They're going to have to decide what to do, but they're not going to know what damage we're going to see from the virus at this point. They can push down on interest rates, but as Bill Dudley says, they're kind of out of tools to add additional stimulus. They could move out their buying to the long end of the curve. You can see it's at the short end, but there's not much more stimulus to be gained by ensuring rates stay where they are. Before we go here, John, just very quickly, Chicago PMI is out 61.1. That is better than forecast. It was 62.4 last week. We were expecting a drop to 58, so a little more strength in the Midwest than anticipated.
My thank you. That's the economy and the stimulus debate, or lack thereof, down in Washington, D.C. Always love catching up with Christina Hooper of Invesco. The Chief Global Market Strategist joins us now to drop in and give her view on this market. Christina, great to see you. Let's just start with this market. Down 9/10 on the S&P, off by 1.6 on the NASDAQ. From the September high on the S&P 500, we're down about 8 percentage points. Tell me why you think we got from there to here, and why that gives you encouragement that we can rebound.
Well, it's been something of a perfect storm, right, Jonathan? We have had concerns about a contested presidential election, a lack of additional fiscal stimulus, which I believe we need desperately. And, of course, add to that COVID infections are on the rise in the U.S., and, of course, they're in much worse condition if we look across the pond to Europe. And what we learned in the spring was that our future was essentially a few weeks away. What we saw in Europe was what was coming to our shores in a few weeks. So we might assume that what's going on in Europe, including targeted lockdowns, might be part of the near future in the U.S.
Christina, are you working on that assumption? Are you making capital allocations that assume that Europe's presence is America's future?
No, I have to say that this is a very short-term situation, and we try to look out over the long term. But it certainly is, I think, one of the key factors that has pushed stock prices down. But we have to recognize, and this is the positive, we are in an environment of incredibly accommodative monetary policy, and that creates an upward bias for stocks, and certainly creates what I would consider to be a pretty significant put under stocks, much bigger than the Bernanke put in the post-global financial crisis period. So the news over the longer term is positive. The conditions are positive, but we do have some pretty significant headwinds now that have created buying opportunities for stocks.
Well, let's talk about those buying opportunities. Back in spring, it correlates pretty well. You should have sold when cases really picked up, and you should have bought when they introduced policies to correct course. Now, in Europe, we've started to see that this week. So let me ask this of you, Christina. Do you think that's the playbook this time around?
Well, I think what the Fed would like to see is fiscal stimulus, but I don't think they're going to get that in the near term. And so I would expect that we at least start hearing the Fed talk about additional accommodation, even if it doesn't deliver it in the near term. But even the current environment that we find ourselves in is incredibly accommodative and very supportive of risk assets.
Christina, always great to catch up. Appreciate your time this morning. Good morning to you. Christina Hooper there of Invesco on this market, down 0.9%. The NASDAQ off by 1.6%. Already talking about the prospect of more Fed stimulus. High yield spreads are anywhere near 600, and we're already having this conversation. Bloomberg's Abigail Doolittle has the sector price action. Hey, Abigail.
Hey there, John. And the sector action is getting increasingly more bearish, similar to the S&P 500's decline, now down by about 0.9%. If we go into the Bloomberg terminal, we'll take a look at the IMAP. 10 of the 11 sectors are lower, not surprisingly, on bottom. Consumer discretionary and tech. Think Apple and Amazon. Those are the biggest drags on the index, on those disappointing nuances around their quarter, worst days since September. We also have Facebook and Twitter tumbling. The one sector that is slightly higher at this point, up about 0.4%, is communication services being helped out by Alphabet. Its best day since March. But the worst week for the S&P 500 overall since March, and these are the worst sectors. All 11 sectors down by more than 2%, John, led by industrials and energy, both being dragged on in a big way. So that cyclical trade not working. We also have the financials down sharply. And then there's technology, one of the worst four sectors as well, down about 6%. Really nowhere to hide, a risk-off week. Again, the worst week since March, John.
What a tough week for the equity market longs, and what a week we've got coming up. Next up, the market-moving events you need to be watching. That'll be next in our trading diary from London and New York this morning. Good morning. This is Bloomberg.
what is happening today in India is actually a determination to rebuild our economy.
India has an opportunity not only competing in the space of the factory of the world, but a very big opportunity to compete in being the office of the world.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
"25 minutes into this session, equities lower, down 0.8%. What a week ahead we've got for you. President Trump and former Vice President Biden campaigning throughout the Midwest, speaking in Iowa, Minnesota, Michigan, and Wisconsin. 3 huge market-moving events coming up through next week, including the U.S. election on Tuesday, a rate decision from the Fed on Thursday, and closing out the week with payrolls Friday. From London and New York this morning, good morning. Thank you very much for choosing Bloomberg TV through the week. I'll be back with you on Monday. This was the countdown to the open. This is Bloomberg TV with the eyes of the world on Washington, D.C. and an equity market that's edging lower with just 4 days to go until the election.
The time has come to elect the next president of the United States, and the stakes could not be higher. 2 candidates, 2 very different paths for the future of the country. I'm David Weston. We will bring you the results as they unfold live on election night. Join us Tuesday, November 3rd at 7 p.m. Eastern Time on Bloomberg Television and Radio.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off. These guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
So there's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very human